So if you have one of these small devices, then please put them away and focus on what you see and what you hear. If you are watching from your phone, then make sure that you put them in a landscape escape mode so that you can see all the numbers a little bit better, and everything will be looking better on your screen. But if you're on a computer, then please put it away and so that it doesn't distract you too much. So you will see in the Zoom window, you will see there's a bar in the at the bottom. So for the chat, if for participation, and Jason will ask you to participate in the chat. So that's what the chat is for. If you have a question, you may want to either wait a little bit to see if your question is being answered during this session, or you may actually want to um, just put it in a Q&A window. So there's a Q&A section where all the questions go into the Q&A window. All right, so today we're going to be overflowing with value, and I would like to present our speakers today. Jason Lowe is a founder and entrepreneur who has founded Life Eva. It's a company that operates in the United States and also Ascendant Financial in Canada, and both our companies are super successful. And we are going to introduce you today how infinite banking can help you in your life and add value, and so you can take control over your wealth. Take it away, Jason.
All right. Thanks, Roman. And good morning to all of our attendees. You definitely made the right decision to join us here today. And as Roman may have mentioned, we begin our sessions on time all the time, and respecting everyone's valuable time. We will definitely end today's session right on time. And I want to begin by just sharing a couple of things that come up when you think about taking control of your wealth. And I'd like in the chat window, I'd like for folks to just share a response that comes up for you when I ask you, for example, if you have money inside of a tax qualified plan, like a registered retirement savings plan or a 401k, how would that put you in a position of taking control of your wealth? But whatever comes up for you, put it in the chat window. If you're storing money in mutual funds, if you've got money parked at someone else's bank, if you've got money tied up in one or more of those instruments, how does that put you in a position of taking control of your wealth? Just want to see what we got. Here we go. Okay. So folks are saying it doesn't. Not really. It's our choice whether to participate or not. Absolutely, Derek. That's a really good point. So when you think of controlling wealth, you probably want to have some of it first. Otherwise, you don't have anything to control. And in order to accumulate wealth, it has to reside somewhere. And when I talk about it, I mean money. And wealth is not money. So when we talk about taking control of your wealth, we're not only addressing the fact that your money has to reside somewhere and that from that place, you can control how you finance the things that you need throughout your lifetime. You can control and be the banker as it relates to your needs. But we're also talking about how to control what wealth really is. More freedom of time, more freedom of money, more freedom of purpose, more freedom of relationships, more freedom to pursue all of the things that you want to do with your family or with your company, or if you're like me, if you own several companies. That is when I say, hey, let me tell you a little bit about taking control of your wealth. That's really what we mean. And when we go into the essence of the infinite banking concept, what I want you to be thinking about is we're going to do a quick exercise here as a group together. And I really want you to think about the answers before typing them into the chat window, because Nelson Nash, who I was blessed to be mentored by for so many years and who developed and pioneered the process of becoming your own banker, he would always begin his talks by expressing everything begins with the way that you think, the way that you think, the way that you think. And the fact is, and the truth is that most people would rather die than think. And he also went on to say that you've got to think long range, meaning you've got to think 3 generations past your own, especially if you put yourself in a position that we're going to coach you today on how to put yourself in. And so let me bring up my screen and let's just see if we're able to see that. Okay, perfect. Yeah, that's coming up just fine. Now, as I mentioned, when we go into this group exercise, please participate via the chat window, and I'll lead you through that. And it's going to be really thought provoking so that you can get your thinking revved up before we move into describing the problem and then discussing the solution to the problem. And then Sarblo is going to dive into some pretty amazing use cases. So you're definitely going to want to stick around for that. It's going to be incredible. And then we'll allow some time for Q&A, because I think your questions become the best answers for everybody else who's in attendance. And so feel free to type in those questions in the Q&A window as we go along. All right. So let's do this. I want to know in the chat window if you can give me a Y for yes and an N for no if you have read this book titled Becoming Your Own Banker. And Roman, if you could come in via audio and just let me know what we're getting in the chat window.
Yes, we're getting most of Y's and some no's. I see one no, and once someone said yes and no, maybe just there in the middle.
Okay,
No, I'm an audiobook. Yeah, most of them are yeses, Jason.
perfect. Okay, now give me a Y for yes or an N for no if you've read the book more than one time, cover to cover.
I have a lot of people saying yes, and 2 people said no so far.
Okay. So, for those in attendance who have not read the book once or even more than once, you have an opportunity and you need to get your hands on a copy of this book. If one of my teammates, just in the chat window, if you just put in the ascendantfinancial.ca/shop, ascendantfinancial.ca/shop, pick up a copy, pick up a few copies. We courier them, we don't mail them. Things get lost in the mail. We courier these copies wherever you want them to go. And so when you get an opportunity, just head on over to ascendantfinancial.ca/shop. And when you get there, select the quantity of this book that you want shipped, and we'll send it wherever it needs to go. Now, the whole purpose of this is that when we do these webinars, these boot camps, these virtual and live events, we encounter people who have attended more than once. And we really value that, because Nelson always said, the more you see infinite banking concepts, the more you'll see you didn't see. And the whole purpose is to get you to rethink your thinking. Because when you first went through the book, you were likely quite amazed and you had a lot of fresh insights and a lot of great questions to clarify your understanding of the concept. But when you read it the second, third, fourth, fifth, sixth time, and so on, I guarantee you, you are going to see things that you did not see previously. And you will develop even fresher insights and more clarifying questions. And then you can run those past one of our coaches. And at Ascendant, there is no one advisor who's above any other advisor or the team. Every one advisor at Ascendant or LifeEva are equally qualified and capable and competent to lead you through the proper implementation and the ongoing journey that you'll have with this concept in your life. Now let's do this group exercise. Okay, So you're doing all the work. Everyone else is getting all your money. I'd like to know, and take a moment to think about it. How does that make you feel? Again, really think about this. You're earning money by working for it, and everyone else is getting that money. How does that make you feel? So, one, doesn't bother you at all. And you should probably take the rest of your weekend back because this isn't going to be a very valuable webinar for you. Or 10, you're furious. What are we getting in the chat window, Roman?
We're getting a lot of tens. Before that, people said sad and angry, and the dislikes.
Okay.
One person said it's a BS.
Okay,
So
perfect. Thank you. Now, what portion of your net worth is completely shielded from any risk of loss or taxation? Now, 1 would be 0%, and 10 would be 100%. What are we seeing, Roman?
we see 1, 23, 10. The answers are super different.
Wow. Okay.
3, 5, 24.
If we have a 10 in there, so if your entire net worth is shielded from any risk of loss or taxation, let Roman know who you are, because I want to meet with you and I want to introduce you to our entire client community. I've never seen or met anybody whose entire net worth is shielded from any risk of loss or taxation. And so I'm serious. We'd love to meet with you and understand what exactly it is that you've done to accomplish that. Okay. Of all your assets, so if you were to take account of your personal balance sheet, your corporate balance sheet, if you're an entrepreneur and you have a company or several companies, or you're just an individual or a family, if you were to take into account all of your assets, what percentage of those assets can be converted into cash before 5 o'clock Mountain Time today without reducing the asset's value and without triggering tax? So that's the caveat, is that you cannot reduce the asset's value and you cannot trigger a taxable event. What?
People say 1, none, 1, LOL, 0,
Okay.
1.
There we go. All right. Okay. That's the most frequent responses that we get. Now, if you were to think about all of the high caliber opportunities that have tracked you down up to this point in your lifetime, and all of the future high caliber opportunities that may track you down in the future, if you were to reflect on the past up until today, how many of those opportunities did you miss out on because you didn't have ready access money on demand on your terms? 10 is more than you can count. 1 is none.
So far, we're getting tens, a lot of tens. One person said 8, 10, 8, 10.
Okay. Now,
Except
that is interesting because that is also the most frequent response that we get to this particular question. I really appreciate everybody's engagement. Thank you. We'll be doing that a few times throughout today to keep everybody sharp and engaged in the talk. So this is so fundamentally important, because what we see out there in the marketplace is that most people that we encounter in this space are describing the infinite banking concept by leading with the solution. And this message from Nelson will live on in eternity, because this is really the door that opens for you to develop a deep understanding of just how remarkable the solution is, which is the infinite banking concept. But unless you understand the problem, the solution isn't going to matter to you at all. So I want you to think about this. If you've ever been introduced to the concept at some point and your brain immediately went to comparing the infinite banking concept to other financial things that you were already doing, like putting money in the stock market or real estate or mutual funds, etc. So give me a Y for yes that you went through that comparison mode after you were initially exposed to the concept, and your brain decided that it wanted to compare the concept to all the other things that you were already doing financially.
Yeah, we're getting a lot of wise, Jason. People are comparing for sure.
Okay, there you go. Now, this is incredibly common. And here's what I want to clarify regarding the infinite banking concept is that it's not an either or. So it's not, should I become my own banker or should I put my money in insert financial product here? This is where there's such a gap in teaching the concept. And that's why so many people miss it initially. In infinite banking is a process. It's not a product, and it is never going to be about addressing the yield of an investment. And a fatal error in thinking is that this concept has anything to do with interest rates or life insurance. Nelson would often say, to people's amazement and sort of kind of deer in the headlights look, when he would say, most people simply don't know that the infinite banking concept has absolutely nothing to do with life insurance. The essence of the infinite banking concept is that it's all a matter of controlling how you finance the things that you need throughout your lifetime. Now, what are some of those things? What are some things that you need to finance throughout the course of your lifetime? Let's type them into the chat window. Okay, we've got a car. We've got a house, car, reno, buying a home. So homes are the most common response that we're seeing here this morning. Everything. Christina, very good. So Christina, you're absolutely correct. Every decision that you make regarding money and a transaction involving money is a financing decision. Now, what do I mean by that? Well, even if you pay cash for things, you're making a financing decision, because when you pay cash for something, you are not only transferring the money away from you permanently, but you're also giving up all of the future interest that that money could have otherwise earned. And you're not just doing that for your generation, you're doing it for every generation that comes after you. Now, that's called lost opportunity cost. Now, people use that lingo, but very few people actually reckon with lost opportunity cost. And there are no exceptions to lost opportunity cost. Nobody is exempt from it. You have to reckon with that. And so what we want to show you through the implementation of the infinite banking concept is not to compel you to change your financial objectives, whatever they may be, but to help you understand that if you change the process of how you go about achieving those financial objectives, which can include investing, then you're going to put yourself in a position of total and absolute control. You're going to create a peaceful, stress-free way of life financially. You're going to control the banking function as it relates to your needs, and someone has to perform that function. There are no exceptions. And you're no longer going to abdicate both the opportunity that becoming your own banker represents in your life and the responsibility of handling and controlling that function as it relates to your needs. People aren't having that conversation. They're leading with the solution. Hey, let's talk about dividend paying whole life insurance and all the financing characteristics. And do you know that you can take a big giant dump into one of these policies? How many of you have heard that lingo before? Dump in. We're not going to teach you how to take a crap in anything today. We're going to teach you how to take control of a function that relates to your needs so that you can build prosperity financially for your family, for your company, for your kids, your grandkids, your key employees, your nieces, your nephews, anyone that you have an insurable interest in. Give me a Y in the chat window if you want to see, because I'm planning to show this and I'm curious if there's an appetite for it. Give me a Y in the chat window if you want to see what we do in our family banking system, because we've been doing this 16 years now.
Oh, we're getting a lot of wise, Jason.
Oh my God. Okay. This
People
is
want to
great. Okay. So this is good. So you got to stick around, right? This is one of those webinar tactics. Like, make sure you stick around for the big reveal. The one thing that what we're definitely going to do is we're going to be asking you to schedule a time to meet with the right person on my team. And again, I cannot emphasize this enough. Every advisor on the Ascendant and LifeEva team are equally capable, competent, and more than happy to serve you. And so we don't have any one superstar or two superstars that rise above the team. We are one team here. And so whomever you get connected with, you're going to be in great hands. I'm just going to step out and say that right now. Okay. Here's the deal. As I walk through the pouring the foundation for the problem, okay, we're going to spend a few minutes getting clarity on the problem. Now, you all mentioned earlier that you have read the book once, maybe more than once, some of you not at all. And so you're all going to have a different degree of awareness of this concept. You're all at a different stage in your journey of researching the concept. And so I'm going to pour a smooth foundation to get us all on the same page, to get us all thinking about our thinking. And then when we dive into the solution, shocker, it's actually going to matter to you. All right, let's keep going. Roman, are we having fun?
Oh yeah, Jason, we are.
Okay, excellent. Now, learning how to think long range is a skill. It's not a statement, it's a skill. And I've personally learned from Nelson, again, having been blessed beyond the definition of good fortune to be mentored by him for so many years, that you've got to be thinking at least 70 years down the road. But the truth is, I won't be here and neither will you. And most people in North America can't think past this weekend. And so let's begin by clearly calibrating on the problem. All of your money is flowing through the books of someone else's bank right now as we speak. And you may not be aware of this, but if you take into account all of that money that flows onto the books of someone else's bank from all of the sources that you see here on the screen, plus many more, the moment that that money lands on the books of someone else's bank, it's not your money anymore. You just become an unsecured creditor of that bank. That money doesn't belong to you anymore. If you want evidence of that, take out a $20 bill, write your name on it with a thick marker. Go to your local teller, deposit that 20, go have a lunch, come back later today and withdraw 20 from the ATM machine. If you got that $20 bill with your name on it, you better rush and go and buy a lottery ticket because you're one lucky human being. The bank's got to keep that money in constant motion. They can't let money sit still because money that isn't moving isn't worth anything. And the bank needs to keep that money flowing in the form of loans, in the form of what? What do banks do? What is the primary function of a bank? Put it in the chat window.
Circulating money.
There you go. They got to keep money in constant motion. Now, we discussed earlier and had you type into the chat window things that you would need to finance throughout your lifetime. Okay, so immediately your brain's thinking about a mortgage or a car loan or recreational vehicles, things that you would finance over the course of your lifetime. If you were to consider all of your major expenses, right? So just think about the month, all the money that you spend and what you spend it on. If you think of that, take a moment and just process that. And you take into account the amount of money that you handle in a year, not the amount of money that you make. I ask people this question all the time. How much money do you make? Oh, I make 100,000 a year. I make 250,000 a year. I make 300,000 a year. No, you don't. You handle 100, 250, 300,000 a year. You don't make that amount of money. You've got money that's flowing through your hands, not into your hands. That's a problem. Because if you take into account how many more months you're going to go through all of life's major expenses, and then how many more months every future generation after you is going to go through life's major expenses, you can see rather quickly, it becomes very evident and obvious that you are really getting hit with lost opportunity cost. Every dollar that flows through your hands and onto the books of someone else's bank amplifies lost opportunity cost in your life. Every time you swipe the debit card, you buy the food, you pay the utility bill, you pay the mortgage, you pay the car loan, you pay the credit card company. Everyone else is getting all your money. You pay the IRS or you pay the Canada Revenue Agency. What a complete idiotic name for a government agency. The Internal Revenue Service, the Canada Revenue Agency. And yet we just sit there and take it. It's the boiling frog syndrome. There's a way to secede yourself from the banking system as you realize and as you interact with it today, so that you can have money flowing into yours, your family, your business's hands, not flowing through. How many of you can agree with me? And I'll need to hear from everyone before I move any further. How many of you agree and have an understanding that that is a problem? Give me a Y in the chat window for yes or an N for no.
Yeah, we're getting all wise, Jason.
Perfect.
Taxation is theft.
Perfect. How are all of these things financed? You're either paying cash, you're leasing, you're borrowing, or you're swiping a credit card. That covers just about 99% of the North American population. That's how you go about your financial affairs throughout the course of your lifetime. And then whatever you've got left over, the banks want to get their hands on it. Mutual fund companies want to get their hands on it. The government wants to get their hands on it. Someone or some other organization thinks that they can do better with it than you can. Now, if you think about financing all of these things through the books of someone else's bank, you're doing all the work, everyone else is getting all the money. You all agree and have clarity that this is a problem. Nelson described in his book, for most of you who have read it, that there are 4 characters in the financial play: the depositor, the borrower, the banker, and the bank owner. The fact is that the majority of you on this call today are only 2 of the 4 characters in the financial play. You're the depositor because you're depositing money onto the books of someone else's bank with every financial transaction that you encounter in your lifetime. You're a depositor. Every bill that you pay, every loan repayment that you make is someone else's passive income. That's something you should write down. Write it down. My debt servicing payments are someone else's passive income. How soon do you want to change that? Put that into the chat window. Tell me how soon you want to change that. What are you seeing, Roman?
We're getting now, today, as soon as it is possible, now.
Perfect. So you're 2 of the 4 characters because of what I just described. But in order to become the banker and the bank owner, you've got to become your own banker. That's the only way to do it. And when you become all 4 characters in this financial play throughout your lifetime, then you are not only going to have the money flowing into your hands, and remaining within your control inside of an entity that you own. You call the shots. You have the gold. You make all the rules. But you're also going to be able to create that peaceful, stress-free way of life financially so that you're actually controlling your wealth being your relationships, your purpose, your financial objectives, all of those things that are so important to you, all of the people that are so important to you. And we're going to go through a pretty amazing questionnaire that I'm going to have you think about, and we're going to have some good chat and bring people on who might want to share in just a short while, because I want you to really process what the advantages of this concept can be for your life. This is an interesting question. Let me know in the chat window if you feel like you're not taxed enough.
People say, please stop that sarcasm. LOL, LOL, way too much text.
Okay, good. Well, here's the truth. And thank you, Roman. And thank you all again for being a good sport. This is, nobody's ever been injured participating in our virtual events. And so really appreciate you being a good sport. But the truth is that in North America, the average family is paying that percentage of their gross household income in taxes. That's the truth. The more you make, the more they take. Now, this guy just filed his tax return and he got his notice of assessment back from the government. So he's not a real happy camper. He doesn't work in our office though, but he's not a happy guy. This is today's public service announcement. What you want to do when you're accumulating capital and you're multiplying capital is you want to shield that capital from onerous taxation. And if you think about this carefully, if the government creates a problem, too much tax, and then turns around and grants you an exception to the problem that they created by giving you the opportunity to participate in a tax qualified plan, like a 401k or an RSP or a tax-free savings account, aren't you just a little bit suspicious that you're being manipulated? All of these products are created under the guise of giving you a tax break. If the government really wanted to give you a tax break, they would simply cut the taxes. Now, it should be obvious to all of you that they have no interest in doing that. And if you were to look ahead into the future, it should also be obvious to you that the government's going to need more money, not less. Now, the reason I share all of this is that it would be important to recognize not only that there are exemptions that exist in the tax code today, and that dividend paying whole life insurance contracts are the greatest exemption that exists in both the Canadian and American tax codes. But the government's going to go looking for that more money in areas where you're already on their radar. You file a tax return every year. You're on the government's radar. Contribute to a 401k or an RSP. You're on the government's radar. You contribute to a tax-free savings account. You're on the government's radar. Am I even remotely suggesting that you shouldn't do any of those things? Of course not. But all that I'm doing is bringing awareness to the fact that you're on their radar. And the fact is that wherever wealth resides, someone's going to try and steal it. It's not a matter of if, it's when. And so you can shield yourself from that. You're most at risk, especially if you're even the least bit effective at accumulating wealth. Now, if you were to examine all of your existing assets and you just asked yourself, which of those assets are a sitting duck for future tax hikes, you've got to address that. You've got to get together with the right person on my team, schedule a time, have a look at it together, and make sure that you're addressing it. You're taking proactive measures so that you can gradually and incrementally shield all of it from onerous taxation. And if you're in a position where you've created a legacy, you've created an estate plan, the worst thing for a beneficiary to inherit is a taxable one. A taxable inheritance is the worst thing to inherit. And if you've got taxable savings or assets, you've got a big problem. So do your beneficiaries. This one really stings. And I'm not talking about interest rates, everybody. I'm talking about volume, the volume of interest. As I mentioned earlier, a fatal error in thinking is that the infinite banking concept has anything to do with interest rates. It's all a matter of where your money is flowing to, who your money is being put to work for, and for how long. Now, what are some examples? If you just entertain me in the chat window, what are some examples of interest payments? Type them into the chat window.
People say mortgage so far.
Oh, okay.
Car,
Mortgage.
credit cards, car
Okay.
loan,
Okay.
line of credit, loans.
Okay. Perfect. Yeah, those are all great examples. Thank you, everybody. And if you think of all the money up to this point in your lifetime that has flowed through not only your hands, but your family. Now, I want you to think about not just your immediate family under your roof. I want you to think of your entire family, your entire lineage. Think of all the money that's flowed through your family's hands up to this point. You may have guessed it right. It all ended up right back in someone else's bank. And if you're a business owner or an investor, the problem is amplified even further. Neither you, your family, your company will ever see that money again. So let's recap. You earn income from a variety of sources. You're taxed. All the money flows to someone else's bank, and yet you repeat that cycle over and over and over again. How does that make you feel? Tell me in the chat window in your own words. How does that make you feel? Roman, what are we getting?
For some reason, my chat isn't working, Jason. If someone from our team can hop on and see what we're getting, be awesome.
You seem frustrated, Jason.
Ah,
Powerless, outraged.
okay, we're okay. There we go. Thank you, Sarblo, and thank you everyone again. Now, here's why you should stop this cycle. You should stop it because this means more money for your dreams. It means more security for your family and the control to truly enrich your life and the lives of others. This is a screenshot that you're going to want to capture because at some point you're going to be compelled to create a time and schedule a meeting with the right advisor on my team. And don't bring any money to that meeting because they're not going to ask you for any. The process of having that discovery session is valuable because you get to explore those clarifying questions and the insights that come up for you on the implementation of this process. You get to look at real world examples. You get to watch how your own plan is engineered and put together to achieve a defined set of objectives. That's what you want to do, is meet with the right person on our team. So don't procrastinate. Take action while the knowledge is fresh. All right. Now, this is something that's an obvious yes. We've never had anybody say, no, actually, I've quite enjoyed every experience that I've had dealing with someone else's bank when I needed ready access to money throughout the course of my lifetime. Well, we experienced that frustration as well. And for me personally, I was just tired of feeling like just being another account number, just being lost in a sea of transactions and red tape. Pick up the phone and call your bank today. And what you're going to feel like is a pinball. You're going to be bounced around all over their call center queue. And when you end up talking to somebody, it's not the person you should have been speaking to anyway. So you're going to get transferred another 48 times before you even get your simple question answered. You've got nosy and lengthy credit applications to borrow money on someone else's terms. So you're not in a position of control. I felt the very same way prior to July of 2008 when I was first introduced to this concept. July of 2008. And I want to share just a quick story about our journey and how that went for us. So in April of 08, this was a few months before we were introduced to the concept, my wife, Rebecca, and I, we had purchased our first home, and you could get 40-year amortization schedules on your mortgages back then. 40 years. So we thought, wow, this is incredible. We've got a mortgage for $426,000+. We've got a really low interest rate, right? Because that's what the bank wants you focused on. And isn't it interesting that the conventional banks make record profits in the lowest interest rate environments? But yet the common consumer thinks that, hey, this is a great lot in life if I get a low interest rate on a loan. The banks are raking in the profit because it's not about the rate, it's about the volume. Because the volume of borrowing goes up, which means the volume of interest in dollars goes up. So for my wife, Rebecca, and I, we didn't know what we didn't know at the time. Active real estate investors, had 13 properties, bought this principal residence, systematically transferring all that money away from us. And then when I was introduced to this concept, we began to implement it quite aggressively in our lives. And we got rid of the conventional bank 33 years ahead of schedule. Now, if you envision this, picture this in your mind. We began to purchase dividend-paying whole life insurance contracts. Now, these contracts are the tool to implement a process. And these contracts began accumulating cash value immediately. Now, cash value, most people don't know that cash value is not money. It is the present value of the future payment of a death benefit. That's what cash value is. But here are the advantages. That cash value is contractually guaranteed to grow daily. It cannot go backward. It cannot be repossessed. You pay no tax on that buildup. You've got a ever-increasing death benefit thrown in for good measure. You pay no tax on that either. And would you believe it? There's not a single person in attendance today that isn't going to die someday. And you can borrow against that ever-increasing cash value, which is guaranteed to match the total death benefit by age 100 of the life insured in Canada and age 121 of the life insured in America. And so every day that you're aging, your cash value is rising. And every premium payment that you make, every dividend that you chunk back into the policy increases the death benefit. You can contribute almost unlimited sums of money. And it's a private contract, and it's unilaterally binding, meaning the life insurance company itself is the only party to the contract that's required to make and fulfill legally binding promises, like a guarantee to increase your cash value daily, like a promise to pay a windfall, a death benefit when you die. And another really important promise, a guaranteed loan provision, where you can request a policy loan at any time for any purpose. The loan is unstructured, meaning there's no repayment schedule, and it's not reported to TransUnion or to Equifax. So it doesn't interrupt your ability to access capital from other banks if you need it. It doesn't affect your debt servicing ratios and the formulas that the conventional banks use to determine whether or not you're a good credit risk and whether or not you can access someone else's pile of money. So I want you to picture this. You can contribute unlimited sums of money, just about. You're growing cash value on a daily basis. You've got ready access to real money, not cash value, by borrowing against the cash value without interrupting any of its daily growth. You pay no tax. You repay a policy loan on your terms. You co-own the life insurance company. How many of you would like to co-own an institution that lends money? If you realize how significant the function of banking is in your life. When you purchase one of these contracts, you become a co-owner of that life insurance company. Now, I'll bet you $1 to a Krispy Kreme donut that nobody from your bank is calling you and saying, excuse me, Mr. Smith, we just wanted to let you know that we've generated record profits this year. And we really appreciate the fact that all of your money is flowed onto the books of our bank. And we want to send you a dividend. Unless you are a stockholder of that bank, that phone call never happening. With the life insurance company, different story. They must, when they have a divisible surplus called positive net income, they must distribute a portion of that net income to all of the participating policyholders in the form of a dividend and take the remainder and leave it on the books of the insurance company as policyholders' equity. So who are the sole beneficiaries of 100% of that net income? If you type into the chat window, the policy owner, then you win the grand prize today. And Roman, the grand prize, I believe, is a set of steak knives.
Yeah.
Okay.
So we have people saying that it goes to the policy owner, Jason, yes.
Okay, perfect. Now, knowing that all of this is true, which it is, I want you to ask yourself the same question that I asked myself in 2008. How much of my money do I not want residing there? Because from that place, I can control how I finance all the things I need. I can invest, if I choose to, in anything I choose to invest in. So all of my financial objectives go on uninterrupted. But the process of how I make those objectives achievable realities changes entirely, and so do the odds. So my wife, Rebecca, and I, after purchasing these dividend-paying whole life insurance contracts, we began to access policy loans. We took the life insurance company's money, because you're not borrowing from yourself, banking on yourself, transacting on yourself, cash registering yourself, whatever all those other creative names are out there that all took what they learned from Nelson and spun it into something they called their own. What you're doing is you're borrowing against your cash value, which is not money. The only money of yours that's going back into the insurance company that you co-own is your premium payments and your loan repayments. And the more capital that the insurance company receives, the more capital they have to multiply. Kind of sounds a little bit like a bank, doesn't it? Except the difference is now you're all four characters in the financial play. Am I depositing money? Sure am. I'm making premium payments. And anybody who tells you that a premium payment is a deposit shouldn't be saying that to you. They're going to get themselves in a lot of hot water with the SEC or other government regulatory agencies. A premium is a payment, period. That's what it is. And you're the depositor. The borrower, you get to request policy loans. You're the banker. You dictate the repayment schedule of your policy loans. You're the bank owner. You participate in divisible surplus generated by the lender that you co-own. And when dividends are declared, which happens once a year, the dividend is contractually guaranteed to be paid. I say that again, contractually guaranteed to be paid, and it cannot be repossessed or lose value ever. And you're not on the government's radar. because it's a private unilateral binding contract. It's not an investment. Tell me in the chat window how that makes you feel.
We're getting optimistic, great, in control, warm and fuzzy, free. And we're getting big smiles. Great. Excited.
Now, when I shared with you that my wife Rebecca and I got rid of the bank 33 years ahead of schedule, I got to ask you one question. Give me a Y for yes or an N for no in the chat window.
A lot of smart people today, Jason.
All right. Now, the first person I called was Nelson. And I said, Nelson, and here he is. He's right next to me each and every day, every meeting I do, every event I do. I miss him. I think about him every single day. And I called and I said, Nelson, I said, I think we solved the problem. we just got rid of the conventional bank today. And he said, in his, Southern drawl, being that he lived and worked in Birmingham, he said, well, hang on there, boy. He said, remind me again, how long was the original loan schedule? And I said, well, it was 40 years. He said, do you want to be an honest banker, son? I said, absolutely. Yes, sir. He said, well, you've got to finish the original loan schedule. You're just going to change the process of who's getting the money. So he coached me in that moment. He said, you've got to continue making the payment. You're just changing the process of where the money's flowing to. Because remember, by getting rid of the bank 33 years ahead of schedule, we had a pretty sizable policy loan balance that we had to repay. But who's in a position of controlling that financing function now? If I went 3, 4, 5, 6 months without making a payment, nobody from the life insurance company is calling me. There's no lien on my home. The lien is on the death benefit of the insurance policies, not the property that we live in. That puts us in a position of total and absolute control. And if there's any volatility in cash flow, we still have a peaceful, stress-free way of life financially because we're not losing a wink of sleep over it. And our total cash value is rising every single day that we are. And God forbid, if the unthinkable had happened to Rebecca or I, there would be no indebtedness left behind to the family, and the surviving family would never have a bad financial day for the rest of their lifetime. So I ask you the same question. Isn't that good? Give me a heck yeah in the chat window if you're with me.
Absolutely. Heck yeah. We have a lot of heck yeah.
Okay, excellent. That's good. Like if your blood pressure isn't stabilizing by this point because you see this as a solution to your problem, then hop off the webinar. Go do something else with your weekend. Every interaction that we have with people matters because we're changing people's trajectory. We're changing families' legacies. We have to fulfill that duty of delivering death benefit to grieving families. And would you believe that not one family has ever said, I wish the check would have been taxed and I wish that the amount received would have been less? Not one person. And so you are in a very blessed position by being here today. Very blessed. And we know, the entire team knows firsthand how this can perpetuate everything that you're doing. But in order to do that, you got to get into the banking business, the family banking business. Now, here are 3 basic facts. Your money must reside somewhere. This is an irrefutable fact. 2, you finance everything that you buy. Even when you pay cash for things, you're making a financing decision. 3, someone has to perform the function of banking as it relates to your needs. There are no exceptions. Here are the steps that you should take because by doing that, you're going to empower yourself with financial independence. You're going to gain control over your economic future. You're going to unlock wealth creation that aligns with your personal values and goals. Here's what you need to do. You've got to be intentional about building a pool of capital. inside of an entity that guarantees daily growth of cash value, ready access to money on demand on your terms. You're going to recapture the interest, the money that you're presently paying to banks, credit card companies, finance companies, for all those things that you need throughout your lifetime. 3, you're going to protect your livelihood, your real estate portfolios, your investment accounts, your retirement account balances, everything that you've worked so hard for from being decimated at the highest levels of taxation. Build a pool of capital where? Dividend paying life insurance. Dividend paying life insurance. Now, most people simply don't understand how the tool works. I just explained it to you through Rebecca and my example, one of many. And why don't people understand how it works? You'll never guess who's buying the most dividend paying whole life insurance contracts on earth. Take a wild guess. Put it in the chat window.
Getting banks, bankers,
Banks.
the wealthy.
And so if banks are the largest purchasers of these contracts and they regard dividend paying whole life insurance contracts as a tier 1 asset on their balance sheet, they're either really stupid and enriching their stockholders, or they know something that you and I don't. Which one do you think it is? If you guessed they know something that you and I don't, that's the right answer. So let's mimic what the banks do and we'll do okay. Now look, here's the deal. If you want to build wealth, then you have got to reckon with a few things. Tax risk, market risk, liquidity risk. There are no exceptions. And dividend paying life insurance addresses all 3 of those risks because you've got ready access capital on demand on your terms without triggering tax, without reducing the asset's value. You eliminate your market risk and you receive contractually guaranteed daily growth that I mentioned earlier, lifetime access to money. You crank up a new business where no business existed before. Dividends cannot be repossessed. They cannot lose value. Your cash value grows every day, can't go backward. You pay 0 tax on the buildup, 0 tax on the death benefit, 0 tax on the dividends. When you chunk them back in to buy more paid up additions, in Canada, it's exempt from the passive investment income tax rules, and you can be positioned to never pay tax on the ever increasing, basically cash, actual cash that you can access throughout the course of your lifetime. Now, would you sleep easier at night if you knew that your money was no longer subjected to these risks? Would you sleep easier? Yes or no? And Roman, I want to hear from everybody.
Yes, please participate, everybody. We encourage everyone to say yes or no. People say yes, darn right.
Okay,
Yes,
good.
a lot of yeses, Jason.
Now, here's what you need to do. And the reason you need to do it is because it's going to be a financial advantage for you, your family, your key employees, everyone that you have an insurable interest in. Grab your smartphone and do something smart with it. Text the word schedule. If you're in America, text it to the number you see on the screen. If you're in Canada, text it to the number you see on the screen. Do something smart with your smartphone and schedule a time to meet with the right person on my team. I promise you that it will be a valuable, very valuable use of your time. That I can assure you. Okay. Now, I promised you I'm going to show you what we're doing in our family banking system. Does everybody still want to see that?
Yes, people still remember, Jason. People still want to see it.
Okay, awesome. So what we do, because most people, when they get exposed to this concept, they're thinking, how can this work for me? That's where your brain is, right? Your brain is very focused on how can this process work for me, the individual? but very few are having the discussion around building the family banking system, which is what we've done and what we're now teaching all across North America. And it is taking off like wildfire. And when I say wildfire, I really mean that. Like, it is taking off like wildfire, because people, even if you already have a policy, maybe you've already taken a progressive step forward in this journey of infinite banking in your life. When you're thinking about growing your program and you're thinking about putting together your own family banking system, we want you to think about Life Eva and Ascendant, because this is what we're teaching. All right, let's dive deeper. So what we do is once a year, we get together as a family and we host our annual family banking meeting. Now, what do we talk about at these meetings? Well, we spend some time in Nelson's book and we'll address a very particular topic that's meaningful to the family at that time. We involve all of the kids. So our kids, including my nieces, nephews, etc., they all actively participate in the family banking system. And if I could have one of my teammates go to the Bankers Vault YouTube channel, so Bankers Vault YouTube channel, and pull up the link to the video of my son and my nephew doing a talk in front of 300 people at a live event in Henderson, Nevada, where they explained a teen's perspective. They're 15 years young, and they explained a teen's perspective on the infinite banking concept. It's a short talk. It was just under 20 minutes, but wow, was it ever impactful. They got a standing ovation. The crowd loved it. And so if teenagers can grasp this quickly, I can absolutely assure you that you can. And in this family banking meeting, we recognize the kids. We recognize the kids for their active participation, accessing policy loans, repaying policy loans. We're launching Next Gen IBC, Next Gen IBC. And my daughter, Charlotte, who you see standing right next to me here, smiling ear to ear, one of my twin daughters, my other daughter, Caitlin, is right next to her. But Charlotte is launching her own podcast named Carly's Coins. And we just finished all of the planning for the podcast yesterday evening. She has her first guests coming on next Friday. And so she is actively going to be coaching and teaching kids about the advantages of the infinite banking concept. These are all the spin-offs, the advantages of family banking. But what are we doing specifically with the family banking system? We're helping develop the skill set of not losing the money. And Joe Polish of Genius Network, if you don't know who Joe Polish is, he's a wonderful guy. You should know and follow him. He founded the Genius Network. An amazing guy, one of the best human beings I know. And he said something at our last session, and he said, you know, wealth is not just about making money, it's about not losing it. And that's an entirely different skill set altogether. Well, this speaks perfectly to the process of becoming your own banker, the infinite banking concept, because everyone in the family was really good at losing money, because they were making all the car payments, buying all the food, paying the utilities, paying all the loans, paying all the credit cards. They were systematically losing all of the family's money. But now the money's flowing into our hands, not through our hands. And I'll show you exactly what our family banking system is. And you'll see the evidence of that. Nelson said, this is meant to be a system of policies. This is not meant to be achieved through the device of a single policy. Nelson wanted people to know that this was meant to be achieved through the devices of a system. And if you want to know what our system is, let me show you. So when we began in July of 2008, our first policy anniversary was in July of 2009. So in 2009, at our first policy anniversary, we had 2 policies in force. We now have 77, and there are 27 lives insured in our family banking system, including all the key people in all my companies, all of our kids, my nieces, my nephews, my sister, my assistant, and so on. Our annual premium in the first year was $16,800. This year, it's $1,050,000. Total death benefit in 2009 was $500,000. As of the end of Q1 of this year, so this number is much higher now, the total death benefit was $40,801,000 and rising continually. Total cash value, which is not money, was $4,250 at the end of 2009 and $3,799,000 at the end of Q1 of this year. And it's going up every day. Every single life insured wakes up tomorrow and the total cash value in those policies is larger than it was the day prior. Loans. First policy loan was for a car seat for my firstborn son, Jackson. You can't get a policy loan for less than $500 today, but back then you could. Today, we have $1.6 million in policy loan balances. We lend capital not only within the family, but we do private lending. So we keep money in motion. We keep it circulating. We have 1.7 million, lot higher today. This was the figure at the end of Q1, 1.7 million in loan amount available. So if a high caliber opportunity tracks me down, can I take advantage of it immediately? The answer is yes, because to request a policy loan, all I have to do is log into my client access account and push request a loan. That's it. There's no lengthy nosy credit applications. There's no income verification. There's no fat cat banker asking me a bunch of questions about why I need the money. The insurance company is the administrator of our 77 policies, not the owner. The owner calls the shots, not the administrator. That's a peaceful, stress-free way of life financially. Loan repayments. Here's the kicker. This is and should be the big aha moment for you. We've got $80,000 a month, every month, flowing into the family's money pool, not through our hands. How are we doing in terms of kicking the crap out of lost opportunity costs now? Let me know in the chat window if you just had a big aha moment. Give me a Y for yes or an N for absolutely not.
So far we have all yeses and wow, amazing.
So thank you, Roman, and thank you again to everybody who's participating. You really appreciate the engagement. The fact is that our family, our key people in our companies, our businesses themselves, they all need the use of money to finance things, to transact. We haven't recaptured 100% of it in the entire family. We still have a distance to go. But just take a second to think about all the money that's flowing through your family's hands and your business's hands. Not into, but through. You've got to change that because you're developing awareness of a process that puts you in a position of controlling that and changing the trajectory of your family permanently. And then, God forbid, when the unthinkable happens and people die, which in our family, that's happened. My father-in-law spent his career working as a police officer. 35+ year career as a police officer. This gentleman that you see right here. He retired, and I said, "Hey, Papa, I want to get you insured. I want to pay for it. So here's something to pay very close attention to. You don't have to be the life that is insured. Every person that you see in this picture, I own policies on." And so I sat down with Papa and I said, "Hey, Papa, I want to get a policy on you." And he said, "Well, I don't think I'm insurable. I'm a type 2 diabetic." And I said, "Well, there's only one way to find out. Let's apply for it. I'll pay the premium. all control access to the cash value in the family banking system. And when that day comes, when you pass away, Nona will not have a bad financial day for the rest of her lifetime. And Nona's standing right next to Papa. She won't have a bad financial day for the rest of her lifetime. And you get to put a policy in place for all of your grandkids, paid up. And he said, wow, that sounds great to me. Like, I don't have to come out of pocket a single penny. I said, no, all you have to do is shop at home for the things that you need financially. So don't go to someone else's bank when you need a new vehicle, new set of golf clubs. You need to plan travel with Nona. The list goes on and on. Come to the family's money pool and we will finance it. So we applied, got him approved. I purchased 2 policies immediately on his life. We anticipated, and so did the actuary at the life insurance company, that he was going to live a long time. Otherwise, they wouldn't have approved him. September of 2020, 5 weeks earlier than September of 2020, Papa was diagnosed with cancer. And in September of 2020, he passed away. I met with him in hospice 3 days before his passing and reiterated, because he was worried sick about Nona. He was worried, right? He was just thinking about everyone but himself. And I said, Papa, everything's going to be fine. We're going to honor your legacy. Nona's going to be taken care of. We'll take care of her tomatoes. We'll shovel her driveway. We'll cut her grass. Like, she's going to be, don't worry, your tomato garden's going to be fine. Everything's going to be fine. And 3 days later, he passed. And we honored that legacy. And so what I want to share with all of you is that you can do this too. You've got to schedule a time. Get connected with the right person on my team. I'm entering my 16th year in this journey. And Nelson reminded me, and so many others, that this is not going to be achieved overnight. But you know what? The rest of your life is going to go by anyway. And so why not gradually and incrementally create a peaceful, stress-free way of life? Because do you believe that less stress adds longevity to human life? It absolutely does. And so knowing that you can do this too, schedule that time. If one of our teammates can put that information back into the chat window, and I'll bring it up on the screen, and then we're going to do a quick exercise together as a group. Let me just bring this up on the screen. There we go. Just take a moment. Let's just all take a moment and do something smart with our smartphones and text that word schedule to that number on the screen. Just take a moment and do that now, because it's going to make you feel great the rest of this weekend. That's why you want to do this now. And as I reminded everyone, don't bring any money to that meeting. You're not going to be asked to purchase anything. There will be zero pressure tactics. This is all about getting acquainted, getting clarity, understanding how this can be an advantage for you. Even if you already have a policy, schedule a time with us. Talk about growing your program. Get your brain into a function of growth, building a future that's bigger than your past. And you will love that conversation that you have with any advisor on our team. I guarantee it. Hey, Sarblo, are you with me?
Writer Jason.
Okay, so what I want to do prior to turning the microphone over to you is I want to go through a bit of an exercise with everybody. And this exercise, do you want to know what I've named it? Because you know,
Yeah.
I always come up with like these like creative names for things. Okay. Here's what I've named it. I've named it Insights to Action. What do you think of that?
Very insightful, Jason.
Okay. So here's what we're going to do. Now, give me a Y in the chat window if you've already scheduled a time to meet with the right advisor on my team. Give me a Y in the chat window. Tell me what we're seeing.
Seeing for yes, Jason.
Okay. The yeses are pouring in.
Yep.
All right. I love that. That's the whole purpose of these presentations, is to get people into a conversation. That's what we want to do. We want to talk to you. Okay. Are we ready for some insights to action?
Sure are.
Okay. And then I'll say, before we dive into it, if you haven't scheduled a time yet, I would genuinely ask. I'm asking this from a place of being genuine. Why not? I want you to list in the chat window the disadvantages of meeting with someone on my team. If we can just if you haven't booked a meeting, if you could weigh in and just type in the chat window the disadvantages of meeting with someone on my team. Please tell me it's
Zero, none,
crickets.
none.
Okay, good. Remember, everything begins with the way that we think, the way that you think. Schedule that time. Okay, here we go. We're gonna go from insight to action. But before we do that, I'm gonna have Charlotte kind of look inside the camera. Okay, she's saying, no, I look crazy. So Charlotte, we've got 83 people from across North America that are on this, and I had announced that you're going to be launching Carly's Coins, your podcast. Do you mind just kind of coming on camera and just waving and saying hi to everybody? Go on. You can do it. Come on. Okay. Thank you for the coffee. I appreciate it very much. She's incredible. Keep an eye on Charlotte. She's going to have a great podcast. Okay. Now, I love you too, sweetheart. Okay, here we go. Let me share the screen. All right. Insight to action time. Now, taking into account you don't have this in front of you, I just want you to make sure you have a pen and paper handy. And then for those questions that require that you circle and answer, just think about your response. But for those that require you to write something down, I really want you to take a moment and write it down. Okay. So think about all the money you spent up to this point in your lifetime. You know that you can't write me a check for that amount of money right now. So you can go ahead and ponder the fact that that's just not an achievable reality. You did all the work to earn all the money. Someone else got all of it. And I've asked you to communicate in the chat window how that makes you feel. Now, you all agree that that's a problem. And we heard from many of you that you want to begin solving the problem now. Now, if for some of you, you don't ever want to solve that problem, thank you for attending today. And you should hop off the webinar now and just take the rest of your weekend and enjoy it. But thank you sincerely for attending. As long as you leave happy, that's okay too. Because some people don't want to solve that problem. We recognize and we acknowledge that. Okay, if you choose to solve it now, I want you to write down why. So let's take a moment right now and just capture in your own words, on your own paper, the reason why you would choose to solve that problem now. Okay. I want you to think about all the people in your family or your business that you would do anything for, including die. Write their names down. There are at least a handful of names that are coming up for you right away. Write them down. Picture those faces, those people. Now, I also want you to contrast that with people in your family or your business that would do anything for you, including die. Either put a check mark beside the name if you've already written it down, or capture the names that you haven't written down yet. I want you to envision, I want you to picture the advantages of having your own family banking system in place. How would this change your family or your company's future? Take a moment, write it down. Sarblo, how are we doing so far? We doing good?
Doing good, Jason. Responses coming in the chat.
And I'm going to turn the reins over to you here right on time. Now, I want you all to picture a day when you have complete control over how you finance all the things that you need throughout your lifetime. How would that control impact the way that you save, invest, and spend money? Write it down. I want you to be thinking about what kind of financial legacy do you want to create within your family? And don't overthink this. Just write down what immediately comes to mind for you. For some people, it's one word. For other people, it's a paragraph. For other people, it's a chapter. Whatever it is for you, I want you to think about your thinking and write it down. And now I want you to answer how the infinite banking concept can help you achieve that legacy. And write it down. And this is one that I want you to take away with you to think about. If I arranged a time to meet with each and every one of you 3 years from today, May 25th of 2027, and we were looking back over those prior 3 years to that day, what specifically would have had to have happened both personally and professionally in order for you to feel happy with your progress? And I'll end it with this and hand the reins over to Sarblo. It's very simple. To know and not to do is not to know. And you have begun to rethink your thinking today. There's no going back. You cannot unsee anything that I showed you today. And what you're about to see from Sarblo is going to be absolutely phenomenal. And so with that, before I hand the reins over to Sarblo, I want to do a quick value check-in in the chat window. On a scale of 1 to 10, 10, you are getting incredible value by spending your valuable time with us. 1, you had hoped that you were doing something entirely different, and I've completely wasted your time. Okay, we got a 5. Wow, I've never seen a 5. Geez, boy, he must be really pissed off, eh?
I saw mostly tens, a billion. Yeah, there's definitely a lot of value. And I just loved how you frame some of those thought-provoking questions and helping everybody just think differently. Thinking is one thing, but thinking about the thinking is a different art altogether.
Yeah, absolutely. Well, hopefully for the fellow at 5, we can get him to maybe a 6 or a 7 by the time you're done. Or maybe you'll tip the scale. Maybe you'll get him to an 11. Who knows? Let's see.
Well, our goal is to add massive value, and that's all we can focus on.
There you go. So without further ado, allow me to introduce my teammate, my right hand, my consigliere, Mr. Sarblo Gill. Sarblo, take it away.
Thanks, Jason. All right, what I'm going to do, I'm going to share my screen, bring up a PowerPoint, and then if someone can confirm, you can hear me okay, or presuming you are, and that you can also see my screen okay.
Yes, Pablo, we got you.
Perfect. So I'm going to dive into some case studies today, and obviously to protect the client's privacy, the name, the identity, I'm not showing any names. I'm just going to walk through very specific case studies. Now, the two case studies that I picked are based on some of the most common things that comes up in client meetings, but I also want to emphasize that infinite banking has no limits. The process of becoming a banker, the reason why Nelson named it the infinite banking concept is because it's just limited to your imagination. It literally has no limits. Although I'm showing two specific case studies, but it could be implemented in so many different scenarios. The process of becoming a banker would radically enhance anything that you are presently doing financially. That's what the process is all about. All right, so here's the outline of the case studies that I'm going to go over. So one case study is about how a family, by changing the process of how they're paying for living expenses, for example, property tax, um, insurance, some of the investments that they make. So how by changing the process of flowing the monies for living expenses, they're now working much stronger towards the ultimate objective, is to create that freedom, create that stronger retirement, and also create a stronger legacy for their family going forward. So the process of becoming a banker is not about changing your goals, changing your cash flow, taking on any risk, or ever losing control over money. It's about just adding one extra step to what you already are doing when it comes to flowing money, and that extra step will radically enhance anything that you do financially. So I'm going to start with the first case study, which is how living expenses flown through this can radically enhance the outcome for the future. That's one case study. The second case study is about debt elimination. Now, I'm not talking about the traditional way of debt elimination. Clients don't come to us for the purpose of eliminating debt, because if they want to eliminate debt, all they have to do is just increase their payments and the debts are going to be eliminated. The reason why they come to us is because they want a better financial way to achieve the desired outcome being eliminating debt. They want to come out ahead financially, not just eliminate debt. So these are the two case studies that I'm going to go over. And then obviously towards the end, a lot of you have asked some really good questions, and we've parked some questions for a general discussion. And any questions that come up from my part of the presentation, we'll cover all that in the group Q&A. So that's also coming up. Now, there's going to be some refresher. Again, the best way to learn is by refreshing your mind. So Jason, such a great presentation. I'm going to just do some refresher on the process of becoming a banker and dive into case study. So Jason mentioned this, every decision that you make with the use of money is a financial decision, right? You either are paying interest to someone else when you're using someone else's money, or you're giving up the interest that you could have earned when you pay cash for the things that you want to buy, your cash, right? Now, so use of cash, that's a method that you use to buy the things. In use of cash, the financing decision that you're making is losing interest on that money, because once you use the cash, it's gone forever. Now, when you use banks' money to buy the things, you have to pay interest on it. So the financing decision is paying interest. The process of becoming a banker, the infinite banking concept, is not about losing interest, it's not about paying interest, it's about recapturing interest. Because when you are operating financially in an environment which helps you recapture interest, you have a financial tailwind that's going to push you ahead financially no matter what. But if you are operating in an environment where you're losing interest or paying interest, then you don't have a financial tailwind. In fact, you have a financial headwind, which is pushing you back financially. So when you use your cash, which is the decision that you make of losing interest, and when you use your cash, who gets to keep your money? Well, it's someone else. You earn the money, you use the money to buy the things that you want to buy, but someone else is now going to keep your money. When you borrow money from the banks, the financing decision is paying interest. And when you do that, who gets all that money on the payments that you're making today for the things that you may be financing, like mortgages, cars, lines of credit, things like that, things that you finance? Well, after your payments are done, someone else got your money. You earned the money, you made the payment, someone else got the money. Whereas with the process of becoming a banker, and here's the reason why you have to work in an environment where you're recapturing interest, because when you work in an environment of recapturing interest, you earn the money, you get the job done of using the money for buying the goods and services, but you and your family also gets to keep the money. People don't implement infinite banking for the purpose of implementing infinite banking. People implement infinite banking because they want to work in an environment of recapturing interest because it creates the favorable desired outcome of keeping money in the family so that you have more money to use in future, retirement time, taking family for vacation, having more money for kids' education, having more money for kids' weddings, whatever it is that you envision using your money. Does having more money available in the future take away any of your options? If it's a yes, put it in there. See, you did all the work to earn money, but there's only one method that allows you to keep all your money in the family, and that method is based on the recapture interest. That's why infinite banking works. So here's a case study. So the first case study is creating a stronger retirement by changing the process of how you're paying for living expenses. So I'm going to stop my screen sharing and I'm going to go right in the middle center here. So let's get some action in the chat. So today you have living expenses. Now, how many of those living expenses that you have to make on a daily basis, weekly basis, monthly basis, semi-annual basis, annual basis, how many of those living expenses are actually creating a stronger retirement for you, meaning stronger access to capital in the future? Type in Y for yes, N for no. It's a rhetorical question with an obvious answer, but I like the engagement, right? So here's another question. Do you want to find a better way to achieve your objective so that you come out ahead financially, AKA so that you have more money working for you in the future, which means you have more money in the future to use for retirement, for anything that you want? Do you want to know a better way? Do you want to change things going forward?
All yeses.
All yeses. Let's talk about change. Now, share in the chat what living expenses that you must set aside money for. What are you saving money for when it comes to living expenses? Give some examples. Just share in the chat. I have some here on the screen too. Food, clothing, mortgage, rent, car payment, home and car insurance, property tax, utilities and cell phone bills, Christmas expenses, getting family together, buying Christmas gifts, traveling on Christmas Day, Thanksgiving, so holiday expenses, basically, family holidays, family vacation. You are setting aside for emergency expenses, and then you're setting aside money in a bank, and when an emergency comes, you take all that money and then you take care of the emergency, but the money is gone, right? So emergency expenses, charitable givings, you're setting aside money to help the charities that you believe in, kids' education, weddings, down payment for a home, coaching, investments, taxes. So these are some of the examples that you have to deliberately set money aside to make sure that the money is there to ensure that these things are taken care of. Now, the only way for you to do that is if you're deliberately setting money aside in an account. Presently, maybe that's money that you're sitting and storing in someone else's bank. But the only way to make sure that the money is there is by taking action and ensuring that you're setting that money aside. You're making a deliberate action. And that action is a payment into someone else's bank. In your mind's eye, you must be thinking you're actually saving money, but you're actually paying into someone's bank to make sure the money is available when these expenses come up so that you can pay for those expenses. Everybody is always making a payment, whether it's into your savings account, whether it's towards your mortgage, whether it's to your car, whether it's in your RSPs, whether it's in the TFSA, whether it's Roth IRA accounts in the US or other registered accounts. The only way you can have the money go into those accounts is if you're deliberately making a payment with an action. You're making a payment into those accounts. That's what's happening. You're not saving money. You're making a payment into those accounts. All right, so I just took some of these expenses and I'm just going to use these expenses as an example here. So we're going to use home and car insurance, property tax, charities, Christmas and Thanksgiving, family holidays, and coaching. And then this particular family, you can see underneath all these expenses, how much they are actually spending on it. So home and car insurance, $2,500 a year, property tax, $5,000 a year, charity, $5,000 a year, Christmas and Thanksgiving, about $2,500 a year, family holidays, $5,000, investments, $5,000. So if you add up all these living expenses, it comes to about $25,000, right? So this is what's flowing away from them presently on these expenses. They're saving money in a bank, and once the money is saved, and when these expenses come up, they take those monies out of the bank, reduce that account, and then they take that money and transfer the money away, and that money is gone. They can never reuse that money again. Hence, it's never going to work for them again to create a better, stronger retirement. All right, just refreshing here. So using your cash, you're going to lose interest. Banks money pay interest. Infinite banking recapture interest. Let's just take some time and understand use of cash, lose interest. Now, everybody, maybe you're familiar with the cost of loss opportunity, but I'm going to walk everybody through a very specific example on cost of loss opportunity because I want you to rethink your thinking about the cost of loss opportunity and how it can negatively impact your future retirement or future access to capital. All right, I'm going to use this example. So GICs in Canada called Guaranteed Investment Certificate, CDs in the US called Certificate of Deposit. So I'm going to use these tools as examples. So let's say today you're able to put money into GICs and CD. Now, is it safe for me to assume that these accounts today paying about 5%? I may not be on the high end. It may be lower than that, but I'm just going to use 5% as example. Now, if you're age 30 today, if you're 30 years young today, and let's say you save $1 inside one of these accounts, and this account is earning you 5%. You're age 30, you put $1, it's earning 5%. By the time you reach age 65, because the power of compounding, that $1 becomes $6. So you're age 30, you put in $1, it's going to earn 5% every year. By the time you reach age 65, that $1 is going to become $6 because of compounding. Now, let's put things in perspective. Let's rethink our thinking and let's see this from the reverse engineering standpoint also. So if you put $1 and it's earning 5%, you'll have $6. Now that also means if you spend $1 in cash today on anything, maybe a cup of coffee, doesn't matter what it is, and you're age 30, because that $1, when you use it for anything, that's gone forever. What it also means is, because of power of compounding, once that $1 is spent, it's gone forever. You're not going to earn any compound interest on that money ever again. You will have $6 less at age 65. So that's the reverse engineer on compounding and loss opportunity. So if you're age 30, you spend $1, presuming this dollar can earn 5% every year, by the time age 65 comes, you'll have $6 less. Now that's just $1. Think about all the cash that you're spending today on the things that you need. Multiply that by 6. That's how much less you're going to have at age 65 if you don't change anything about that action today. If you're age 40 and you spend $1 in cash, by the time you reach age 65, you'll have $3.50 less to spend. If you're age 50, you spend $1 as cash. By the time you reach age 65, you'll have $2.15 less. If you're age 60 and you spend $1 as cash, by the time you reach age 65, you'll have $1.30 less. And that's just an example, just to make a teaching point, how important is to fix this problem, the problem called cost of loss opportunity. And becoming a banker helps fixes this problem permanently. It's a permanent solution, not a temporary solution. So we're using examples of these living expenses and everything, if you add everything together, it's 25,000. Now I'm going to use that 25,000 and run it through the same example. Let's see what happens. So if you're age 30 and you spend 25,000 on living expenses based on the example that I'm sharing today, by the time you reach age 65, you'll have 143,000 less. That's just 1 year, 25,000 that you're going to spend on living expenses. That's not factoring in year 2, year 3, year 4, year 5. That's just 1 year. You spend 25K at age 30, you got 143,000 less. You spend 25,000 at age 40 on the things that you need, your own cash, you'll have $87,000 less at age 65. You spend 25,000 at age 50, by the time you reach age 65, because of your decision of spending cash, that's your behavior, you'll have 53,000 less at age 65. If you spend 25,000 in age 60, by the time you reach age 65, you'll have 32,000 less. Now, you know your financials better than anybody else, so run your financials through this example and do the math. And if you see that as a problem, which I know you do, then we have a solution. A picture is worth 1,000 words. This is what the cost of lost opportunity is creating for you in the future. You have a bucket with holes and it's full of water and water is leaking because of cost of lost opportunity. Now, if you weren't aware of future financial impacts based on things that we have shared today, we are here to share with you. It's not your fault because you didn't know about it. But we're also going to ensure that you understand that it is not your fault because you didn't know about it, but it is your problem to solve. And you're the only one who can solve your problem. So if you haven't scheduled a call, go ahead, schedule the call, and let's have a discussion on how the process of becoming a banker can help enhance anything that you do financially, even in addition to putting you in a better, stronger retirement position. And there's a solution, and the solution is the process of becoming a banker. And the reason why it's going to help you put in a better, stronger financial position, because you're not going to be working in an environment of losing interest or paying interest. You're going to work in an environment of recapturing interest, which is going to create a financial tailwind going forward, no matter what. So this is another way to conceptually see how you are paying for your living expenses presently. So in the bottom, it's zero line, it's $0 line. It's age. So on the left-hand side, I'm presuming this person is age 40, and the right-hand side is age 65. So you have to save purposely with an intention to set money aside for living expenses. You're saving money in someone else's bank account by actually paying into that bank account. Payments in life are not going to end. You're already paying into someone else's bank account. Start paying into your banking system. So you save money by paying into someone else's bank account. And once you have enough money to use for living expenses, you're withdrawing that money and you're coming down to zero line again. And then you go back and you start saving money intentionally for very specific living expenses. And the only way you can save is by paying into someone else's account. And once you get to a certain point of account value, then you use that money to buy the goods and services. You're down to line zero again. And this process of saving by paying into someone else's account and using that money coming down to line zero continues no matter what. And this is the reason why all this money that you're setting aside, saving and using and saving and using for living expenses is not working for you in the future, because it's not about the living expenses and what you're going to use the money for. It's the process that you're using to accomplish the objective, which is flawed. And becoming a banker is a much better process to achieve the objective. And here's how it's a better process to achieve the objective. Now I'm going to compare the traditional way, which I just went over, with the becoming a banker way. So same scenario, age 40, you're age 40, and then you're going to go to age 65. When you start putting money aside into your banking system, there's going to be accumulation of capital called cash value. And once you get to a certain point where you have enough money to use for living expenses, you're not going to withdraw the money and come down to line zero. What you're going to do is you're going to borrow against a growing pool of capital via policy loan. And if you borrow money as a loan, your pool of capital is still going to continue to grow no matter what. And to make sure that the money is available for the next time to accomplish the same objective, you're going to make a payment no different than how you're making a payment into savings account. You're just going to make a payment by paying back the policy loan. And the moment you make a repayment by paying back the policy loan, you're not down to zero. You're actually way ahead than what you even started at because you're not interrupting the growth of your capital. And now when you need more money to buy anything else from living expenses standpoint, you just borrow money again. And borrowing money from the policy, it's contractually guaranteed. There's no qualification. There's no income verification. You just demand the money, money shows up. And as you access money for living expenses, your pool of capital still continues to grow uninterrupted. And then to ensure that you have the money available again for the next year's expenses, no different than how you've been paying into savings account to ensure the money is there every year, you just pay the loan back. You're doing the exact same thing. But the only thing that's different now is you change the process to do it. And then here's another example. You take another loan for another objective and the money continues to grow. And then to ensure that the money is available for the next objective, you just save by paying the loan back. And this is the delta that you're going to end up creating now. So you're going to be way ahead at retirement time. It's going to put you in a much better, stronger financial position for yourselves, your families, for your business. And all you did was you changed the process to make it happen because this process is a process of recapturing interest. Now, here's a case study. Let's walk through case study. So this person is age 46. The objective is to have stronger retirement. The objective is to keep the money in the family. That's the why. That's why we do what we do. We want to have money to spend in future, not run out of money. And we want to have money in the family so that when we graduate, when we leave this planet, when we become an angel, we can provide more additional wealth to the family. So these were the expenses. And we're going to gradually move these expenses through the policies. And I'm going to show you just by changing where the money is sitting and just by using a different process to accomplish the objective, how they came out ahead financially much better in future retirement time. Because you're going to spend the money anyways. They're going to spend the money anyways. They're going to do the actions that they have to take to make sure the money is saved and then spent and then resaved and then spent. They're going to do those actions anyway. They just did those actions with the policy instead, with the process of becoming a banker. Now, who here believes in instant gratification? So type in why that you believe in instant gratification or type in no. Because in the era of instant coffee, instant tea, instant this, instant that, anything worth considering takes time. There's no instant financial freedom. You have to work at it. You have to be disciplined about it. You need coaching on it. You need guidance on it. And that's where we come in. You're going to need money, not today, not tomorrow, not for day after, not for this week, not for this month, not for this year. You're going to need the use of money for the rest of your time on planet Earth. And this process is going to be with you for the rest of your time on planet Earth.
It's all no's.
All no's. Perfect. Now, here's a really good question. So the question is, are you worth 70 cents an hour? So type in if you think you're worth 77 cents an hour. So James says yes. And those who are saying no, I'm guessing you're saying I'm worth way more than 77 cents an hour. More than that. Exactly. So everybody's worth way more than 77 cents an hour. And then there's a reason why I'm sharing this, because I want to make sure that you rethink your thinking. So if you're worth 77 cents an hour, so if you take 77 cents an hour, multiply by 40-hour week, and let's assume we work for 48 weeks a year. There's about 52 weeks in a year. But let's presume that we work for 48 weeks per year. So 70 cents per hour multiplied by 40-hour work week, multiplied by 48 working weeks in a year, that equates to about $1,479, $1,479. I'm going to round it off to $1,500 per year. So if you worth $77 per hour, 77 cents per hour, that equates to $1,500 per year. Now, here's a question. Will it bend or break your lifestyle if you set aside $1,500 per year for a better and stronger financial position? So will it bend and break your lifestyle if you set aside $1,500 per year, 77 cents an hour for a bigger, better, stronger, risk-free, tax-free financial future?
We're getting no, Sabo.
Perfect. Now we're gonna use that $1,500 an hour, $1,500 a year, and strategically build a system of policy. And I'm gonna walk you through how it's all done. And then we're gonna plan on how we're gonna store monies for living expenses inside the policy, and how we're gonna use a policy to accomplish the objective of paying for living expenses. No different than how someone is doing using a traditional bank, same scenario, but then we're gonna contrast the outcome different. Is it better through this system, or is it better through the conventional system? Remember, the conventional system is losing interest. This is recapturing interest. All right, participating dividend paying whole life insurance, some components. So there's premium. So in our case, the premium payment. So we deposit money into the system via premium payment. It's going to be $1,500 per year, which I just walked everybody through, 77 cents an hour. And everybody was like, yep, I can set aside this much money. It's not going to bend and break my lifestyle. So premium is going to buy death benefit. It is life insurance, and death benefit grows tax-free in this policy. Death benefit is always paid out tax-free also in Canada and in the US. Cash values is the capital, as Jason walked us through, is your capital, which the insurance company is on the hook to grow on a daily basis. The cash value grows tax-free on daily basis. And then there's contractual guarantees inside a participating dividend paying whole life policy. The cash value must grow every day to match the death benefit by age 100 in Canada and by age 121 in the US. That's the set contractual guarantee. So every day you wake up, you're one day closer to age 100. Because you're one day closer to age 100, your pool of capital cash value increases because cash value must grow every day to match the death benefit by age 100. Now, when you have a participating dividend paying whole life insurance contract, you just don't own the insurance contract. You actually co-own the insurance company using or via this contract. So when insurance company is profitable, which these companies have been profitable over 200 years combined, in US and about the same in Canada, these companies pay out dividends to the owners of the business, and we co-own the business, and that is paid via dividends. And dividend is the profit that we received based on our share from the money pool. The dividends are also tax-free, provided the dividends are structured properly, and we always structure the dividend properly to ensure that that dividend and any future dividend is always going to be tax-free, because we work in a tax-free environment inside this policy. So if you're becoming your own banker, you have a family income, and then obviously, we set aside money from living expenses. Technically, everything after that should go into the policy itself. But if you truly want to practice the process of becoming a banker, you should be technically putting all the money inside the policy or system of policies. Now, you have to work to get there. It doesn't happen overnight. So I'm just showing you a conceptual example of the contractual guarantees inside the policy. So typically when we meet with family, there's husband, wife, there's just children. So we end up creating a family banking system. There's multiple policies. Policies can go into policy on the husband, policy on the wife. Sorry, premium could go into policy on husband, policy on wife, and policy on a child. So let's assume husband, wife, child. So we put the premiums in. Premium buys death benefit. It is life insurance policy. So once the premium is paid inside the policy, it buys death benefit. Death benefit creates cash value. And the reason why the insurance company is piling up cash value and growing cash value is because cash value must match the death benefit by age 100 in Canada and by age 121 in the US. The other thing that shows up in the policy is policy loans. And what you can access as a policy loan is 90% of your cash value. So based on insurance company contractual guarantee, which says cash value must match the total death benefit by age 100/age 121, the cash value is going to grow every day. And because the cash value increases every day, your access to capital via policy loan also increases. So cash value grows every day to match the death benefit by age 100/age 121. And then the way we structure the policy is every year on policy anniversary day, your death benefit is going to increase. Your death benefit is made a moving target. And because your death benefit is increasing, it's going to proactively grow more and more cash value. So cash value is going to continue to accelerate even better going forward then, because cash value must match the death benefit by age 100 or age 121. And as policy owner, when an opportunity strikes, you have full access to the capital. You can access capital via two methods. One is you can access your cash value. And the other thing that you can access, or the other way you can access money, is via policy loans. Policy loan is not your money. Policy loan is insurance company's money. Now, who here believes in earning uninterrupted compounding? Type in yes. Why? If you believe in uninterrupted compounding. If you access your own capital, you're going to interrupt the compounding. If you access insurance company's capital, then you're not going to interrupt the compounding of your capital called cash value. So if you have a choice to access money, do you want to access your capital or do you want to access insurance company's capital? So which one would you access? Please share in the chat. Policy loans, which is insurance company's money, or your capital called cash value? Roman.
We're getting insurance companies, policy loans, insurance companies money, so
Perfect. That's exactly what this family is going to do. As they park money inside this policy via premiums, they're going to start accessing policy loans to accomplish the objective of buying or paying for living expenses while their capital inside the policy continues to grow. And to ensure the money is available next year for living expenses, no different than how they were saving money via paying into a bank account, and then they withdrew that money. And next year, to make sure the money is still available in their bank account, they restarted saving money by paying into another bank account, and then they withdrew money. They're going to do the exact same thing with the policy. They're going to park that money inside the policy via premiums. And then once the money is there for living expenses, they're going to borrow money against the growing pool of capital. And to ensure that the money is available the following year, because living expenses are due every year, all they're going to do is just repay the policy loan. They're going to save the money back by repaying the policy loan. They're already recycling money through their bank checking account. They're going to do the exact same thing, recycle the money through their own system. All right, so let's structure the system. So premium. So there's two elements to the premium. One is the required premium, which is going to be based on 77 cents an hour, which is $1,500 a year. The other portion of the premium is called deposit option. So if, in this particular case, if someone is putting in $1,500 per year as required premium, on top of that required premium, insurance company allows additional deposit option of, in this case, $5,000 per year. And this has been designed exclusively to help them build a system that they can use to finance their living expenses. This is a custom design. So everybody's needs are customized when it comes to becoming your own banker. So $1,500 is the required premium, which the insurance company needs. $5,000 is the optional premium, which is where they're going to park their money for living expenses. So total monies that they're going to put inside this policy is $6,500 per year, which is a combination of $1,500 and the $5,000. Now, the required premium, so if you think about the required premium, what it's doing is building that foundation, is making a foundation strong. Now, once that foundation is strong, then they can park extra monies at deposits on top of that. Because they have a strong foundation, they'll be able to save those extra monies with no issue at all. But if they have a weak foundation, then they're not going to have that much of room or capability or capacity inside the policy to put that extra money in. So 1,500 is going to build that foundation. So think about the Empire State Building. So this black section in the bottom, that's the foundation. And they needed a very strong foundation to put the extra stories on top of the Empire State Building. And it's one of the tallest buildings in the world. So the required premium is going to be that foundation. And then the $5,000 per year is going to be the deposit option that they're going to put in every year. And as they start to build the system, it's going to become stronger, better going forward for the future. All right. So again, just summarizing, $1,500 per year required premium, and then they're going to pay $5,000 per year to build a system to recapture the living expenses. And then these were the living expenses. All right. Now, what I'm going to be doing now is I'll be going through some numbers, some values. So just giving everybody a heads up, if you are, again, joining our webinar via a smartphone or a tablet, and you have it in a portrait mode, I would strongly encourage you to move it into the landscape mode, because that'll help you see the screen a little bit bigger and better. All right. Building the foundation. So let's start with the foundation. Let's start with $1,500. Now they're 46. Now, one thing that we can do inside a policy or system of policies today, we can backdate the policy by 1 year and kickstart it. So they're 46 today. They can start today, but they understand the value of catching up on the miscompounding. So they want to go back in time by 1 year and start the policy so that they're compounding their system since last year, not starting today. So we're going to backdate the policy by 1 year. So we're going to start at age 45. And I'm going to show you what happens if you just put the required premium in $1,500 per year. That's just the basic foundation. That's not becoming a banker. That's just the basic foundation. The other way to think about it is if you already are setting money aside for emergencies, for things, for life, well, set that money aside as required premium so that as the system grows, you'll be able to tap into the system for your emergencies. Emergencies in case sickness happens, in case unexpected expenses show up, or in case death occurs. Because that $1,500 that they're going to put into policy per year is going to buy a boatload of death benefit. So if they live a long life, they're going to have enough access to capital for emergencies, expenses, and things like that, some basic emergencies. But in case they become an angel, there's going to be a boatload of tax-free death benefit that's going to come in for the family, because that's when the family needs the money the most. And no tax is going to be paid on that death benefit. So the orange line is the cash value. So as they continue to put $1,500 per year, you can see the cash value is increasing, and it's increasing to match death benefit by age 100. I'm using Canadian policy designs. In the US, it'll go till age 121. And the blue line is the death benefit, and you can see the death benefit increasing every year. And because the death benefit is increasing every year, the cash value will accelerate every year going forward, because we keep adding more runs to the ladder. The end age 100 hasn't changed, but we just keep buying more and more death benefit. Hence, insurance company has to grow cash values even quicker. So if we put $1,500 from now till from age 45 all the way till age 65, so 1,500 multiplied by 21 years, that's 31,500, and cash values of 42,829. So we are definitely getting out more capital out than what we put in. And from now till then, in case emergency happens, things like that happen, they can tap into the system for that purpose. Rather than putting that money aside in a bank, they just redirected that money inside the policy to have the money sit inside the policy. And obviously, they also had some additional death benefit that got created. Now, this is not their only policy. This is one of the policy that they started exclusively to finance living expenses. They have additional policies. This is only one of the many policies that they have. So this is not the only death benefit. This is death benefit in addition to other death benefit that they have in other policies. All right, now let's start moving these monies inside the policy. We created the foundation using $1,500 per year, 77 cents per hour. And now we're going to start moving these monies inside the policy, and then we're going to start using the policy to finance living expenses. All right, and here's how we're going to start. So there's 6 expenses that we're going to move in the policies and 6 expenses that we're going to build the system to finance every year going forward. Now, we backdated the policy by 1 year. So we put $1,500 for last year as required premium, $1,500 for this year as required premium. Because we started the policy last year, we can put $5,000 off the property tax as the deposit option for last year. So instead of saving that money in a bank, they just saved that money as deposit option, and that went in for last year. And then the charitable giving that they're setting money aside, which is another $5,000, they're going to take that money and put it in for this year. So $1,500 for last year, minimum premium, $1,500 for this year, minimum premium, $5,000 for last year for deposit option, $5,000 for this year for deposit option. So we got both of those monies in immediately, because when we backdate the policy by 1 year, we get to put 2 years of total premium in immediately. So $6,500 for last year, $6,500 for this year. So again, they haven't changed their cash flow. They just changed where the money's sitting for now. And because they put monies as premium, obviously the death benefit increased significantly. Because death benefit increased significantly, now they have more cash value accumulation. Now that they're going to have bigger dividends also going forward. So let's see what happened. All right. So property taxes, they were saving this money for last year. They put that into the policy. Sorry, they were saving this money in the bank. They put that into the policy. Charitable giving, 5,000, total of 10,000 went into the policy. Now, they need these monies back right away because they pay property tax every year. They contribute to charities every year. So immediately, because now we are in year 2, because we backed the policy by year 1, we put last year's premiums in and we put this year's premiums in. So we are in year 2 right now. So immediately their cash values are $12,004. The policy loan available is 90% of cash value. So 90% of cash value is 12,000 multiplied by 90%. That's 10,800. So if they need $10,000 to pay for property tax and charity or charitable givings, they have all that money now inside the policy, and they're going to access that money via policy loan. So they need $10,000 to pay for both these things. They can access 10,800. So they're going to initiate a policy loan of $10,000. Now, when you initiate a policy loan, remember, policy loan is not your money. Policy loan is insurance company's money. Insurance company is a business, and the objective of any business is to create profit. So when they give you money as a loan, they're going to charge interest on that money, because if they don't, then they're not fulfilling their contractual guarantees to us as policy owners who also co-own the business. They're creating all this profit for us. So if they can deploy this capital somewhere else and earn a profit for us, why should they give this money for us for free? So they're going to charge interest on this money, and the interest presently is 6.5%. So this particular client, because they want to take back $10,000 for living expenses, they took a policy loan for $10,000. And let's just say that interest was outstanding for 1 year, because they were paying back the money over the year to ensure the money is available for next year, because they're going to need property tax payment and charitable giving for next year. So they repaid the loan back, which is $10,650. The $650 is the interest paid to the insurance company because they took out $10,000. 10,000 multiplied by 6.5% is $650. So what they repaid is $10,650 from year 2 to year 3 to make sure the money is available year 3 to redo the same transaction again. They paid back $10,650. Now you can see the cash values at year 3 are now $13,958. It's right here in the bottom. They paid back $10,650, but now they can reaccess $13,958. So all the interest paid on the loan was recaptured inside the growth of the policy. So loan repaid $10,650 from year 2 to year 3, and they have access to $13,958. Would you call that a progress? See, they were going to save that money anyways in a bank. If they save that $10,000 in the bank and they use that money for property tax and charity, the objective would have been accomplished, but all that account balance is now got down to 0. And then to make sure that money was available next year to do the exact same thing, they would have intentionally repaid the money back inside the bank and saved back the $10,000. But all they can access the conventional way is another $10,000 again. Whereas with the policy, they repaid back $10,650, $650 being the interest, but now they can reaccess $13,000. Because they're working in an environment which helps them recapture the interest. Because when they initiated a policy loan, none of the cash values ever got interrupted. It all kept growing. And the growth in the cash value far exceeded the interest that they're paying on the policy loan. Hence, they recaptured the interest. So if you work in an environment of recapturing interest, then you have a net financial tailwind. But if you're working in an environment of losing interest, then all you can use is the money that you put in, and that's about it. So that was the 2 of the 6 living expenses that they wanted to recapture. Now, after this is all done, let's see what else do they have. So the extra capital deposit in the policy was $10,000 for property taxes and for charitable giving. So it was $5,000 each. At age 65, the cash flows are now $70,739. It was $42,000 at age 65 if all they were doing is putting $1,500 per year, the 70 cents per hour, if all they were doing was putting in the foundation. Because they put additional $10,000 in, you can see it increased the access to capital at 65 to 70,739. So the net increase of money just by putting this $10,000, which is a difference between these two, is 28,739. So they had the use of $10,000 and they have the use every year going forward to do the exact same thing that they wanted to do. But now they created 2.8 times more money in the future for retirement. But if they were doing everything that they wanted to do the conventional way with the commercial bank, all they would have had was the use of 10,000, all that money would have been gone, and none of that money would have shown up for them for future retirement. So just by changing the process, they're creating better, stronger future retirement for themselves. And obviously, don't forget the death benefit, because in case, God forbid, something happens as they're banking, there's going to be boatload of now increased death benefit that's going to show for the family. Because monies going in as premium increases the death benefit, increases the cash value, increases the dividends going forward. So we did property tax, we did the charity. So both those have been moved into policy now. Now we're going to start moving the other things inside the policy. So number 3 is now family holiday. So this family spends $5,000 per year on vacation. And they've been doing this for several years. They're going to continue doing this going forward. And if they don't change everything about how they are buying and paying for those vacations, none of that money is going to work for them ever again. They're going to have less going forward for themselves and their family. So we're going to add that now to the policy. All right, so now we got the property tax in, we got the charitable giving in. Now we're going to move the family holiday of $5,000, total of $15,000 of those living expenses, and now in the policy. Now, cash value at year 3 is now $18,830 because money is going in as premium, boosts the cash value. So now they put $15,000 in, they got $18,830. 90% is what they can access as a policy loan because they're only accessing policy loans. They do not want to interrupt the future growth of their wealth. And 90% of $18,830 is $16,947. All they need is $15,000 to ensure that this year they can pay their property tax, this year they can do their charitable giving, this year they can take their family for vacation. So all they need is $15,000. There's more than enough money for them to finance $15,000 of these expenses. And they do that by taking a policy loan. Policy loan interest is 6.5%. And then they're going to repay the loan back, no different than before. So they're going to pay back the $15,000 that they borrowed plus the interest. The interest is $975, and they paid it back over the year. So from year 3 to year 4, they paid back the loan. And the moment they paid back all the loan, at year 4, they have $20,947. So they paid back $15,975, but they can access $20,947. So now they're creating access to more and more capital. And the reason why that is happening is, and I'm repeating myself, and I'm going to repeat myself a few times today, because they never interrupted the growth of their capital. Their capital, called cash values, continued growing inside the system. Again, they repaid $15,975 and have access to $20,947. $975 was the interest on the policy loan, $15,000 the principal. They can re-access all of the money again that they repaid as a loan, including the interest that they paid to the insurance company. And by paying the interest to the business that they co-own, in this case, the insurance company, they're making their own business much more stronger, which means more profits for everybody who's participating. So the more of us practice the process of becoming a banker, the more financial energy of interest we redirect back into our system that we co-own, the better we all become financially going forward. But if they were saving this $15,000 in a bank, so I'm going to just stop the screen sharing. So if they were setting aside these $15,000 in expenses in a traditional bank, and they can only do that if they're intentionally doing, and the only way to do that is making a payment into that bank. And they saved all the $15,000, and now they need money for property tax, for the charity that they contribute to, for the family vacation. Now they have to take all the money out and pay for the things that they want. And to ensure that they have money next year, they have to resave this money again. But the only thing that they can reuse is the money that they're saving again, which is $15,000. So they're recycling $15,000 from the bank. And they're doing the exact same thing with the insurance company. They haven't changed the goal. They haven't changed the cash flow. But now, by recycling money with the insurance company, they have access to more and more capital going forward. And would that put them in a better, stronger financial position? Or would that put them in the weaker financial position going forward? And also, here's a question: did they change the cash flow by implementing the process of becoming a banker? Did they took on any risk by implementing the process of becoming a banker? Did they lose access to money by implementing the process of becoming a banker? And if the answer is no, if they can do it, so can you. All you got to do is just change the process to get to the objective. All right. Now, here's what else they created for them for future retirement. They put the extra $15,000 as deposits into the policy for the 3 living expenses, and they recycled all that money out again. But by putting that $15,000, because again, money went in as premium, and the moment money goes as premium, it'll buy more death benefit, which will create more cash value growth, and it'll also give them more dividends. That extra 15,000 now at 865 created 83,589 in terms of access to capital. If they were just doing the basic foundation, $1,500 per year, it was 42,000. But moving 2 of those living expenses, it was $70,000. By moving 3 of living expenses now at 865 is 83,589. So the net growth of capital retirement just by moving $15,000 is the 83,589 minus the 42,000, which is 41,589. So by parking 15,000 in, they created not just the use of the 15,000, they can recycle that money for living expenses, but they also created 41,000 in future retirement, which is about almost 3 times more than what they put in. And all that is tax-free. Again, they're going to do this anyways. They're going to recycle this 15,000 from a traditional bank anyways. But none of the 15,000 is creating anything better for them in the future. Just by doing it to the process, they haven't changed the objective, but they created additional benefits for them and their family going forward. And again, not to forget about the death benefit. So we moved 3 things. Now we're going to move number 4, and then number 5 and 6 are going to be moved right away because we can move $5,000 per year. All right, let's move number 4, which is coaching and investments. So we moved property tax, charitable giving, family holiday, coaching and investment, total of $20,000. Cash values at year 4, $25,798. 90% of cash value. This is how much they can take out as a policy loan, $23,218. They only need $20K to pay for these expenses. So they take out a policy loan at 6.5%, pay for the expenses, and then they pay back the policy loan. So the money is available next year to do the exact same thing. The loan repaid is $21,300. And the cash access when the loan is repaid is now $28,460. So pay back $21,300, access to $28,460. Pay back $21,300, access to $28,460. And what else did they create? So at 865, the 42,000 was a cash value with just basic $1,500 per year. 70,000 was the cash value by moving 2 of these expenses. 83,000 was the cash value by moving 3 expenses into the policy. 95,000 is the cash value by moving 4 expenses inside the policy. And they put $20,000 more, and then this is the extra cash value they created in retirement time. So the difference between 42,000, which was based on just the minimum, and 95,000, which is based on putting the 20K in, the difference is 53,729 in extra cash values at 865. So just by storing the money and recycling the money through the policy, they created additional 53,000 in the future. Let's just say that's another 3 times more. Again, they're going to do that anyways. They're just doing it differently now. All right, let's move number 5 and number 6 all at the same time because each year they can put $5,000. So now all those 6 expenses have been moved into the policy. So cash values at year 5 at $33,323. All those expenses amount to $25,000. 90% of cash value is $33,323, which means they can access $29,000 as policy loan. They only need $25,000. So they access the policy loan, insurance company's money, while the money continues to grow. They're going to repay the loan back with interest to ensure that they have the money again next year to pay for these expenses. So they're going to repay $26,625. And the cash value at the end of year 6 is $36,577. So they repaid $26,000 and have access to $36,000. If they did that $25,000, recycle the $25,000 from the bank, all they could access every year is $25,000. By recycling it through the policy, Yes, they're doing 26,625 because they're paying interest because they're not using their money. They use insurance companies' money. But look, they're creating access to more capital, 36,577. And it's just going to get better every year because the cash value is just going to get better every year. But the 25,000 is going to be the same that they need to recycle. Now, by moving that 25,000 in the policy, the cash value is now at 865 or $107,000. So it's not that they have high access to capital today to do the things that they want to do by recycling money to the policy. They also are creating bigger, stronger retirement in the future. And the difference between 107,249 to 42,000. So this was just if they just did the bare minimum $1,500. This is if they moved all that money inside the policy. So the difference is 65,249. So $25,000 of redirecting that money created 65,000 in the future. So by taking control over 25,000 in living expenses, it resulted in extra 65,000 retirement. Now, did they change the objective of paying for living expenses? The objective was to pay for all those 6 living expenses. They didn't change their objective. Did they take on any additional risk with the new process to accomplish the objective? They did not. Did they accomplish their objective of using the infinite banking concept? 100%. Did accomplishing the objective via infinite banking created additional financial wealth for them? 100%. But if they did it the conventional way, using the traditional banks, this never would have happened. Now, are they also working towards being more retirement ready now as compared to how they were doing? 100%. By taking control over 25,000 of living expenses resulted in extra 65,000 at retirement. For every $1, they created additional $2.50 in retirement. Tax-free, risk-free at retirement time. Now, how many of your dollars that you're spending on living expenses creating additional $2.50 at retirement time? Let's hear it. For all your living expenses, how many of your dollars are creating additional money at retirement time? Type in yes, I'm creating extra money using my living expenses, or type in no.
We're getting not enough.
And for no.
We're getting not enough.
Now, here's a question. Do you want to change that? Do you want to change the outcome? If the answer is yes, all you got to do is text the word schedule. If you live in the US, text the word schedule to 813-793-7921. If you live in Canada, text the word schedule to 780-809-4599. And here's the reason why you should schedule your call, because it'll give you clarity on how this can be customized towards your objectives. And I know everybody wants to know that in the webinar. That's why you're here. So schedule that call because it'll help you gain clarity on how this can work for you. And once you see how this works for you, then you can make a decision if this is something you want to do or not. We haven't had one single client call us today saying, hey guys, I'm really not happy that I keep growing my cash values every single day uninterrupted. It's really bothering me. And I have full access to this money. And as I use it, the money still grows. And when I repay it back, I can reuse all this money again. It is working beautifully, and I'm not happy about it. We haven't had one single client call us yet on it. So you need to schedule a call because you need to know how this works for you so that you can make a decision if there's something you want to do or not. Infinite banking is not just for the rich. Infinite banking is all about prioritizing the flow of money. And it has nothing to do with how much money you have and how much money you make. You're going to use the money anyways. Just recycle that money like a banker. You don't need a lot of money to start becoming your own banker, but you do need to start becoming a banker so that you can keep a lot of your money in your families going forward for yourselves, for retirements, for your kids, for your legacy, whatever your goal is. That's why you need to start it. And this is how you can do that by texting the word schedule to a US number and a Canada number. Well, the next case study that I'll go over is debt elimination. Jason, do we want to address some questions before we get into the next case study? Give everybody a little bit of brain break.
Sure. Yeah, that sounds good. Hey, let's give Sarblo some love in the chat window. That was pretty remarkable. Really, really remarkable. All right. Yeah. So let's tackle some questions. Do we want to have maybe a teammate hop in and look in the Q&A window and see what burning questions have come up for folks that we can tackle? Roman, what do we got?
So one of the questions we have, we had at the beginning of the webinar, the bootcamp, is Jason said that infinite banking has nothing to do with life insurance, but why would someone need to qualify for the insurance then?
That's a really good question. So there's a distinction between what you're buying versus what you're implementing. And there's a lot of marketing going on where you may hear phrases like, you can purchase an infinite banking policy. Come and get your infinite banking policies. They don't exist. What you're buying is a dividend paying, participating whole life insurance contract, or ideally a system of contracts. What you're implementing is a process. There's a distinction, and it's unequivocal. And in addition to that, what Nelson meant is that he wanted you to understand that if you put the best tool for the job, so the life insurance contract is just the best tool to get the job done. That's what he wanted people to understand. He didn't want people to shift all of their focus on the tool. He wanted you to focus on getting the job done. And the job is to reclaim that banking function and control it as it relates to your needs. And so, why doesn't it have anything to do with life insurance? Because if you put the best tool for the job in the hands of an incompetent, meaning someone who just focused all their energy on learning about the tool, but didn't and doesn't spend any time focusing on getting the job done, then not only is that person not going to turn out any good work with the tool, they're going to break the damn tool. And then they're going to blame and point the dirty end of the stick at the advisor when the only person you got to be pointing the dirty end of the stick at is yourself. So just understand the distinction that the policy is a tool, the concept is a process. The policy is a tool, the concept is a process. Focus on getting the job done. Let our coaches help you purchase and then utilize the tool to get the job done. Isn't
Awesome.
that good?
Absolutely.
All right.
Thanks, Jason. Another question is from Shaiza. I think it will be really beneficial for the audience to actually answer this question live. What happens if the person cannot pay back the policy loan because of the loss of job?
The insurance company sends someone to your house to slash your tires. I'm joking. I'm just kidding. That's not what happens. So there's we engineer the policies for maximum flexibility so that in the event of something like that happening, there is a wide variety of options to keep the policy in force, to temporarily, not have to come out of pocket for premium as outlay from your own financial resources, and then you can resume, and pick up where you left off at a future date. So that's why, again, you need a really good coach so that when you perhaps encounter something like that financially in your life, you've got someone standing right alongside you to help guide you through that difficult period and then get things back on track for you when your financial situation improves again.
Perfect. Thanks. Another question is from Cole. Cole is asking, what is the policy loan process looks like?
Sarpla, you want to tackle that one?
Sure, Jason. So policy loan process is a very simple process. Now, insurance companies have also come a long way since, we started this. It used to be a single page document that you had to complete with your policy number, your name, how much you need, sign it, date it, and then zap that in via email to the insurance company with your banking information. And that's basically how easy it was to request a policy loan. And then within 5 to 7 business days, the money would be in your bank account with no questions asked. Now it's just done electronically. So there's a button on your client portal access, and you can just click on that button. It says request a policy loan, and they're going to ask you how much money do you need. You just put in how much money you need. And they're going to ask you, do you want the policy loan to be sent to you via electronic deposit or via check? And you can select whichever option you want, and then you just hit submit. And then based on your way of requesting policy loan, whether it's electronic deposit or you want to check, they'll just do exactly how you want it. It's a very simple process. Takes literally, I don't know, like 5 to 6 seconds, 10 seconds maybe at the most, to get it. And then it's just 5 business days to get the money electronically in your bank account. If you request a check, then it's Canada Post or in US mail, or how long they take.
Yep.
But EFT, electronic transfer, is the best way.
Perfect.
Yeah, we've requested like thousands and thousands of dollars of policy loans. Our clients have requested in 6 figures, and it's the same process.
Yep. We've had a few 7-figure transactions, and it's just as fast. It just takes for transactions that exceed a certain threshold of 6 figures. It's just takes a little bit extra time in days to get that capital into your account, but it's all seamless regardless of the amount.
Yeah.
Another frequently asked question is, how do you guys make money?
Well, we get paid in US and Canadian currency. And if anybody wants to send us a check, you can find our addresses on the lifeeva.com website or the ascendantfinancial.ca website. No, it's Saturday. I'm trying to be funny. The insurance companies themselves establish the commission schedule, and we are compensated very well. We're blessed beyond measure. We're paid very well to do what we do, and it's the insurance companies that have set those schedules. And so we just let folks know, like, if you have any questions or any insights or concerns with what the insurance company is paying, take it up with them. We can't change that. They pay us what they pay us, and it just happens to be extremely well.
Right.
Thanks.
We got one more case study to go over. It's called the debt elimination. So let's ask everybody in the attendance right now, would you like to pay off your debt in a smarter way? Or would you like to learn how to pay off your debt in a smarter way, so that you just don't achieve the objective of eliminating debt, you actually come out ahead financially much more stronger with positive net worth and more money to be used in future? If you are, you're going to love this next case study. All right, back to my PowerPoint. I'm going to share my screen. So debt elimination, again, it's not the conventional way of doing things. People don't come to us for conventional ways. They come to us because conventional ways don't work anymore. They want better, smarter ways. So we call it the debt recapture, because the value is not in eliminating the debt. The value is in eliminating the debt and taking control over the payments that you were sending over to the banks, because you're the banker now. There's value in being the banker. So the case study, so it's a debt elimination case study. Now, before I dive into it, I just want to ask a simple question, and because I want to frame some thinking going forward, right? It's just simple stuff. So if you have $12,000 in debt, let's just say it's at 0%, and I would like everybody to participate in it. So if you have $12,000 in debt and it's a 0% interest rate, and your monthly payment is $1,000 a month, may I ask, how many months will it take for you to eliminate this debt? So you owe someone $12,000, it's at 0%, and you're making $1,000 a month in payment. How long is it going to take for you to pay off the debt? Yes, the answer is 12 months, 1 full year. You guys are very smart. That's awesome. Thank you for participating. Now, let's fast forward 12 months. So if they did exactly what I just described, 12 months from today, was the objective of paying off debt accomplished? The answer is yes, it was accomplished. Now, how much net worth was built over this next 12 months when they had $12,000 in debt to begin with? They kept paying $1,000 a month into it. And 12 months from today, the debt was all eliminated. How much of net worth got created from this transaction? Anybody wants to share? None. Zero. Nada. How much of the cash, the $1,000 per month that they used to pay down the debt, how much of the cash is now working for them and their family? Zero. So again, it's not about changing goals, changing cash flow, changing objectives. It's about changing the process to get to the objectives. This is the conventional way of doing it. Now, the real reason why Americans and Canadians have less money at retirement time isn't because they spend so much money, so much of their money paying off their debts, the mortgages, the car payments, the lines of credit, the credit cards. It's not just so much about they spending all this money paying off the debt. The real problem is, the real reason why they have less money at retirement time is because they're using the wrong process to pay off the debt. They're using the conventional process of paying off debt, and they're not building any additional net worth. That's the problem. Becoming a banker fixes it. Your current process of eliminating debt involves you transferring your money away from you permanently. That's why you're not going to have enough money in the future. That's why you're not going to keep money in the family. That's why you're going to have less to use. That's why your kids are going to have less to use, and their kids are going to have less to use. So again, if you use your cash to pay off debt, someone else gets your money. You use your banks, paying interest, someone else gets your money. But if you use the infinite banking concept, because it's a process of recapturing interest, and if you use this process to eliminate debt, then you and your family keeps the money in the family, and you'll have more of it to use in the future. So the biggest problem in eroding your financial future net worth is the fact that you're operating in the wrong environment. This environment, you're doing all the work to earn money, and everybody else is getting your money. That's the problem, right? So this is a case, husband and wife scenario, very basic. So husband, his name is Glenn. Sorry. Mouse is just too sensitive. So husband, his name is Glenn. He's 48 years young. He's in IT sales, makes about $160,000 per year in income. His wife, her name is Sheila. She's 45 years young. She works she works in a banking environment with commercial banks. Her income is $120,000 per year. We're not going to hold against Sheila that she works with a commercial bank. So her income is $120,000 per year. Now, in addition to the income, she also gets the $20,000 per year in bonus. And that bonus, that extra bonus, is what they're using to achieve their objective of eliminating debt faster. So they already have a lot of debt, and you're going to see that. And they're taking that bonus to basically accelerate the debt pay down. And after they came through a training session, after they learned the process of becoming a banker, reading Nelson's book, they had a eureka moment, and they wanted to change the environment or the process that they're using to accomplish the objective, because they want to do better for themselves, not the same anymore. So here's some of the debts that they have. Mortgage balance, $650,000. Payment is $4,000 a month. Fair market value of the property is $1 million. A line of credit is $50,000. Interest is 10%. Payment is $420 per month, which is just interest only payment for now. Glenn has a card balance of $50,000. Interest is 4.5%. Payment is $700 a month. He's got 7 years to pay. Now, again, this is a case, obviously, to protect their identity. I'm not using the exact names, but this is a case that has already been closed. Like, this objective of eliminating these debts has already happened. So I'm just sharing with you their case. Sheila has a car. She's got a balance of 10% on the car. 0% is the interest rate. And her payment is $500 per month, and she's got 1.6 years to go. And her question was, hey, I got a 0% interest rate on my car. I'm not going to focus on paying off my car because of 0%. I'm going to focus on paying the other debts, which is a 10% and 4.45%. Well, here's a question. If you ever had a 0% car payment, or you presently have a 0% loan, yes, you may not be paying interest on it, but how much of the interest are you earning on the money that you're using to pay down the debt? She's got 0% interest on this loan, but how much interest is she earning on this $500 a month? 0% also. And they have some credit card debt. They just did some recent renovation. The property had put about $10,000 in credit card. Obviously, it's the highest interest rate at 21%. And they're just making a minimum payment. In fact, they were sending more money. So from her bonuses, the $20,000, she was taking those bonuses, putting it into different debts to pay it down, to accelerate it. But after coming to the process of becoming a banker, what we first thing is we do is we readjust what they already are doing presently. We add some efficiency to what they're doing presently, and then take action on the process of becoming a banker. One of the things we do is we give the bank the least of the money. We give the bank only what they need. We don't give them more than what they need. For example, on credit card, all they're paying now is $175 a month on the credit card. They were putting extra in. We don't want to give the bank extra of their money. We're going to pay off the debt to the bank by using insurance company's money. so that our money continues to grow and compound in the policy, but we're not going to send our money away because of this cost of loss opportunity associated with it. So I'm going to remove the mortgage because mortgage is an elephant, and the best way to eat an elephant is one bite at a time. So I want to isolate it. I want to focus on the other debts, the lines of credit, Glenn's car, Sheila's car, and the credit card. Now, so if I add up all those debts, if I add up all these numbers that you see on your screen, the balance is $120,000, and the total payment is $1,795 a month that they are sending on those debts per month. Now, here's a question. And please give me your responses in the chat. Roman, can you please share with me the responses that you get back? First question is, who owns the debt? Is it the family or the banker? Or if you guess the banker, you're right.
We're getting the banker, the family.
Yes, the banker owns the debt.
Yep.
Next question is, who controls the debt? Owning is one thing. Who's controlling the debt? Is the family or the banker? If you
It
guess
is the banker.
Now, who gets to reuse all the debt payments when the debt payments are paid? Is it the family or the banker?
We have a very smart group of people today at the banker.
Absolutely. Now, who is doing all the work to pay down the debt? Is that the family or the banker?
Sadly, it's the family. It's you. It says you, family, family. Yep.
And on whose balance sheet are debt payments assets? The family or the banker? The banker, obviously, right?
Yeah.
Now, who comes out ahead financially on those transactions? The family or the banker?
Banker, big time.
Now, the banker always wins. Your debt payments are someone else's passive income. So this is a scenario. Someone has a mortgage payment, they have a car payment, they pay for appliances, house remodel, they have furniture loans, they pay for credit cards, family vacation, investments. So they have these pools of money beginning of the month, and by the end of the month, because they're making all these payments, all those monies go to the commercial bank, transferred away from the family forever. And all we are teaching you today is change the role, become your own banker, so you can do the exact same thing that you want to do, but keep the money in the family. That's all we're looking at accomplishing here. Now, here's a question for you. What is the downside in becoming a banker? Do you see a downside in becoming a banker? If there is, please share. I want to know what the downside is, because I've been trying to find the downside in becoming my own banker. And so are several thousand clients that we serve. And the best kind of banker that you can become is become your own banker using the infinite banking concept. This is the best kind of banker that you can become, and is the quickest way to become a banker. So here's a question for you. Now, if these are the debts, so lines of credit, car one, car two, credit card debt, and you can see the interest rates, you can see the payment. If you were working towards eliminating these debts, which of this debt would you pay off first? Which one would you focus on? Would you prioritize the debt with the highest interest rate, or would you prioritize the debt with the highest payment? Or will you prioritize the debt with the least amortization? Which of these debts will you prioritize? Roman, what are we getting?
No answers yet. Highest payment, car number one.
Okay, so that's good. Now, my mouse is just so sensitive today. All right, so this is the screen. So I asked which of these debts would you prioritize first, and everybody had different things to share, which is fantastic. Thank you for sharing. Now, first things first, as I mentioned, is we add efficiency to what we're doing. So what we're going to do is we're going to create an order in which we're going to prioritize these debts. And this is how we're going to prioritize it. So the correct answer is we're going to start with the debt number C, which is the car 2, and then focus on debt number D, which is the credit card, and then focus on the debt number B, which is the car 1, and then focus on debt number A, which is the line of credit. The line of credit is going to be the last of the debts that we're going to focus on. We're going to start with number C, and then we're going to work in this order. Now, how did I come up with this tactical order? Well, we use a formula. It's a simple formula. And this formula has, and this formula helps us create a snowball effect in terms of eliminating the debt. That's why we use this formula to prioritize which debt we want to tackle first. And the formula is simple. It's called the cash flow index. And the way you calculate cash flow index is you take your loan balance and you divide it by the minimum payment. And when you do that, it's going to give you a number, and that number is called cash flow index. And based on where that number ends up on this range, that's the priority that we're going to set. So if the cash flow index is less than 50, that debt is a decent, efficient debt as compared to the cash flow index for debt, which falls between 50 and 100. Any cash flow, actually, the one that falls less than 50 is in the danger zone, and this is the least effective, and we want to tackle that debt first. The ones that fall in the zone above 100, so if the cash flow index number is above 100, and that's the debt which is the most efficient, you're in the happy zone, and that's the debt we're going to tackle the last. So this is how we make a decision on which debt we want to tackle first. So you can see the cash flow index numbers based on the loan balance and payment is right here. And hence, we want to start with the car loan because it has the least cash flow index number, which means it's the least efficient debt, and then work our way towards all the debts gradually. And this is how we create the snowball effect, which helps eliminate debt in the quickest time period using this logic. Now, Sheila's annual income is, annual bonus is $20,000, and that's what they've been using to accelerate the debt pay down. So that is basically the source of premium. So that's where we're going to get started. So 20,000 becomes goes into the family bank as premium. Now, presently, Glenn already has $1.5 million in life insurance, although it is term life insurance. But good thing is he has life insurance for now. So we're going to take that $20,000 and we're going to do a policy on Sheila because Sheila presently has no life insurance. And as we work towards debt elimination, we'll gradually add some policies also on Glenn. But right now, we wanted to just fix insurance on Sheila. So we took $20,000 per year, and that's the premium. Now, this $20,000 has everything built in, the minimum required premium and the deposit option. It's all built into this $20,000 based on my last example. Now, the minimum required, as you can see, is $48.19. So basically, if you do the math, $48.19 minus $20,000, that's the deposit option in the policy. Starting death benefit is $400,000. Obviously, the death benefit is going to increase every year. The cash value is going to accelerate. Cash values grow every day, and that everyday growth accelerates every year going forward, and so does the dividend. Now, total debt without mortgage. So I'm just going to focus on all the debts without mortgage. The balance is $120,000. Now, obviously, just like the last case, we're going to take advantage of backdating the policy. So they had $40,000 saved. They took that $40,000, and then they took $20,000 of that, put their premium for last year, and then took the remaining $20,000 and added the premium for this year. Now, if you don't backdate the policy, the process still works. But if you can backdate the policy, try backdating the policy, because then you can start compounding a year in the past versus starting today. If you're not able to backdate it, that's fine. The process is still going to work beautifully. So we backdate the policy by 364 days. So we deposit as premium payment $40,000. Immediately on day one, so we put 20 for last year, 20 for this year, their cash values right away are $30,817 on day one. The policy loan available is 90% of cash value, which is $27,735. And the cash value is growing every day, $10 per day, because the cash value must grow every day to match the death benefit by age 100. Now, we're going to initiate policy loans right away to start eliminating the debt. And policy loan interest rate at that time was 6.25%. So if I take $27,735, which is the policy loan, and multiply it by 6.25%, which is the annual interest, and divide that number by 365, because the interest on policy loan is charged and calculated on a daily basis. So the daily interest on the policy loan will be $4.74. And the daily growth in the policy is $10 per day. So you can see they already are recapturing the interest charged by the insurance company inside the growth of the policy. So they have a net financial tailwind of almost $6. Because if you work in a recapture interest environment, you have a tailwind. You use this money, insurance company's money, to eliminate debt. The debt goes down, but your wealth, called cash value, still goes up. Now, interest recapture, financial tailwind. So daily growth is $10. Interest and policy loan is $4.74 per day. Now, here's a question for you. Will you have any issue paying $4.74 in interest to have $10 per day in tax-free, risk-free, cash value growth every single day, and it's just going to become better going forward? Will you have any issues doing that? If you have issues, type in why in the chat box, and I would like to understand why would you have an issue paying $4.75 and still make $10?
No.
All right. So, sorry, Roman, what's that?
We're getting no's. No.
Perfect.
No issue.
Good. So again, just going back to the debt. So now what I'm going to do is I'm going to open a PDF annotator and I'm going to walk you through the full plan. I know one of the gentlemen in the chat had mentioned, hey, I want to work towards eliminating my debt. Well, you can see how we plan all this together. So one thing I want to note is, and then this is for this particular example, just so that we can keep this example very simple. Glenn and Sheila, as they're working towards paying down the debt, they're freeing up the capital because they pay off the debt. The bank doesn't need that money, but they are presently not using the capital to pay back policy loan. Can they use the capital to pay back policy loan and recycle the money? Absolutely, yes, they can. And that's how they should do it. I just want to keep it really simple for visual, for understanding standpoint. And so I'm showing that they're not paying back the policy loan. All right, let's open the PDF document. And Roman, can you confirm that you're able to see the PDF document okay?
Yes, Abba, I can see it clear.
All right, so this is the debt recapture plan right here. I'm just gonna make my stroke. All right, this is good. All right, so first thing first is you can see the month and the year. So started April 23rd, April 2020, 23rd. These are the months. The premium is $40,000. So when they put $40,000 into policy, 20K for last year, 20K for this year, immediately they have a policy loan available of $27,000. You can see that right there. I'm just gonna. So that's what's happening. There's a separate segregated account, and I'll come back to what this account is. And then on the right-hand side, you can see all the debt types. So the car 2, the credit card, the car 1, and line of credit. And this is the sequence is based on the cash flow index number. So you're going to start by paying off car 2 and then work our way towards paying off the line of credit. And then you can see the balances on all these debts right here, the interest payments. And then the monthly payment, sorry, that's the interest. Yeah, that's the interest rate. And the monthly payment that they are making towards these debts. So all that shows up right here. We've already gone through all this, but I just want to show to you where it's on their debt recapture plan. All right, let's begin. So they put in $40,000, 20K for last year, 20K for this year. Immediately they have access to $27,735. So they take all that money, $27,735 off insurance company's money. Now, because they're using insurance company's money, their capital called cash value is continuously growing inside the policy. So they took insurance company's money and then they eliminated the two debts right away because they can access $27,735. Car 2 is $10,000. Credit card is $10,000. So they're able to pay off both these debts right away. And the balance, which is the difference between 20K and 27,735, that got applied to car 1. And then you can see there's a reduction in the loan balance on car 1. Now, when they eliminated the first two debts, so these payments which they were sending away to the creditor for car 2 and credit card, well, the credit card company and the car loan company doesn't need these payments anymore. So when you add these together, it's $675. Now they're going to redirect those monies into the segregated account. They're already paying the creditor. They're just going to start saving that money in a segregated account. Again, I'm just showing this just to keep this example really simple. Ideally, they actually took that money and started repaying the policy loans, but I didn't want to create any more complication. There's a lot of numbers. I want to keep really simple here. So they're setting aside that money because they already are accustomed to sending that money away. Now they're just accustomed of setting aside those monies because they want to eliminate the debt as soon as possible. Now they continue to make the payments towards the car loan. So the payment on the car loan, $700 per month, that hasn't changed. So you can see gradually by organically paying that $700 per month, they're reducing the car loan balance. On the credit card, they're just serving the interest. So $420 per month, that's all they're serving. And then hence you can see the balance on the line of credit is not reducing because they're just serving the interest on the line of credit. Now, they have 675 coming back every month, and then just by virtue of setting aside and being disciplined and conquering Parkinson's law. Parkinson's law, if you don't know Parkinson's law, please Google it. So they conquered Parkinson's law. They're not spending this newfound money. They're setting this money aside into the segregated account. And just by virtue of being disciplined about it, by the end of the year, this is how much they have set aside in that account. Now that $8,100 could have gone towards paying back the policy loan. Like I mentioned, just keeping this really simple. Now, next year, April 2024, they pay the premium of $20,000 and they immediately have access to $17,385 right away on day one. And they took this policy loan, they added it towards the $8,100. Now the total that they can access is $25,485. They took that money and immediately they reduced the balance on the car, which was $34,000 right a month prior. When they put this $25,000 in, the balance reduced to $84,111. And then they continue to make the car payment because the car company cannot give them a vacation on the payment because they're not the banker on the car payment. So they continue making those $700 per month in payment. And you can see organically the balance is going down. And the process of recapturing money continues. So the first two debts which were paid off, they were setting aside $675 per month. They're doing the exact same thing. Now, if you fast forward to month 20, just by virtue of them setting aside those monies in the segregated account, they have $4725 already saved. Now, organically, because they've been paying down the car loan $700 per month, by the time they reach month 20, there's more than enough money inside the segregated account to pay off this car loan balance. So now all the car loan balance has been repaid. Well, they could access $4725. This balance is $3529. The extra money they just put on that line of credit, which is the last debt, and that debt reduced to $48,804, which changed their monthly interest payment. So they actually have more money now because initially they were making interest payment on $50,000. Now they're making interest payment on $48,000. So they have more cash flow, which I'm not even accounting for. So now they have three payments, the $500, the $175 plus the $700. And now they're recapturing all those monies in this separate segregated account. And you can see accumulation is happening right here. Now, April 25, next year, 24 months in, they're going to put 20K into policy. This is how much they'll be able to access right away. And they access that $19,000 and they add the $6,875, which they have saved in the segregated account. Now they have $26,140 to use, and then they take that money and then they lump sum that on the line of credit. So you can see the balance from $48,000 came down to $22,000. Obviously, when the balance on line of credit went down, the interest calculation also changed. Hence, they were sending lesser money to the bank. I'm not factoring that extra cash flow in for this example, just keeping it very, very simple. So they continue with recapturing money and they continue with setting aside money in the segregated funds from all the three debts that they have recaptured. And if you fast forward to month 36, April 2026, now they put in the next premium of $20,000. This is how much they'll have access to policy loan. They have recaptured $19,000. We add these together, that's $38,976. That's more than enough money to actually eliminate the full line of credit completely. So 4 debts of $120,000 added together, all the balance $120,000 eliminated in 36 months. And all these payments, which they were sending away to the creditors, the creditors don't need that money anymore. So now all those payments are going to be redirected back into the banking system because the debt is now controlled by them. Hence, they're going to get all the payments now. Whosoever owns the debt gets the payment. So the bankers, so-called the snakes and dragons, eliminated in 36 months. 36 months, $120,000 of debt gone. The only thing that they have is the mortgage, and that's what they're working on. That's what they'll work on going forward. Now, if they stop now, if they just stop by eliminating the debt, they're going to miss on the biggest opportunity that they have, which is controlled by them, is their behavior. They'll miss on the most important step in wealth creation and having more access to capital at retirement if they don't pay back the policy loans. So here's what they're going to do now. They have all the money that they were sending away to those creditors. Creditors are paid off. Now going to take that money and they're going to replenish the pool of capital in their banking system by recapturing that money because the debt is in their system now. Now, here's the reason why they're going to recapture. If you only take money out of your banking system and you don't replenish it, you're definitely going to run out of money. And that's going to be caused by your behavior, not someone else's behavior, because the insurance company can force you to pay back the policy loan. You have to be an honest banker. If they had no problem sticking with the bank's amortization, they should have no problem sticking in with their own amortization to their own banking system. Now, do you know, here's a thought-provoking question. Do you know how much money do you think you're going to need over your remaining lifetime? Does anybody know how much more money do they need over their lifetime? Do you have that number in mind? If you have, please share the number. And if you don't, just say no. And I don't know what the money is. I don't know how much money do you need. I don't know. What I know for sure is I'm going to need a lot of more money going forward because things are just going to become more and more expensive. So then be an honest banker and replenish your pool of system so that you don't run out of money. So policy loan balance, because in this example, as I said, they're not going to pay back policy loans until the debts are paid off. Total policy loans taken are $84,088 to eliminate $120,000 in debt. The interest and policy loan accrued to $3,387 because they weren't paying any loans back. They're the banker. They decide when to pay it back. So the total loan balance after 36 months is $87,475. The cash inflow per month is $17.95 a month because that's how much they were sending away towards snakes and dragons on those payments. They don't need that money anymore. So you're going to take that money, $17.95 a month, and then use that money to pay off all the policy loans. Total policy loans repaid in 4.5 years. So this $87,475 of policy loan balance using $17.95, all that money recaptured in 4.5 years. So 36 months to eliminate debt, 3 years to eliminate debt, 4.5 years to recapture money, everything done in 7.5 years. Everything. $120,000 in debt eliminated and recaptured in 7.5 years, start to end. This is a policy. So by year 7, they've recaptured everything back in the system. And I'm going to pinpoint at year 8 what's happening in the policy. At year 8, when they put $20,000 as premium in the policy, because 7 years to eliminate debt, now they're at year 8, the cash value growth from year 8 to year 9 is $27,986. They put in 20, the growth is $27,986. So what really end up happening by using this process to recapture the interest, they end up not just reducing their debt, they end up building a stronger net worth in this tool where it's producing more money in growth than what's going in. So when they started this journey, this is how the life was. The red represents all the debt they had. The green was the policies. They were just getting started with the policy. And as they worked towards recapturing debt, the debt went down and the net worth and the policy just kept going up. So they end up in a big positive net worth, extra cash, extra capital, keeping money in the family that now they can spend on other things that their family needs money on. So what do they have now? Do they have less stress? We can't put a price tag on it because all those $120,000 in debt is paid off. Do they have more control because they don't have those payments to the bank? They have an entity where the money is sitting that they own, they control, they have first right to access this money. And when they access this money, the money still grows. And when they access money, they can repay the loan back on their own terms. They have more control. Yes. Can't put a price tag on it. Monthly cash flow from payments, $17.95. That's when they took that extra money, or that's when they're going to take that money and do another policy on Glenn. Now, Glenn also gets a whole life policy. Cash value growth, year 8 to year 9. Increasing $27,986. They put in $20K. Now, if you're investing money today Think about this. What rate of return you'll have to earn on an investment of $20,000 so that it gives you $7,000, almost $8,000 of net profit, net after taxes, net after fees. What rate of return will you have to earn on the investment? You put in $20,000, but at the end of the year, your profit is almost $8,000. I'm not even factoring in the risk. Policy is not an investment, but just by virtue of them deciding to put money in, storing money in $20,000, the cash value growth is $27,986, tax-free, risk-free, all the money available to them on demand when they need it for opportunities. The death benefit started at $400,000. Death benefit increased to $868,000. And now the cash value is growing every day to match $868,000 of death benefit by age 100. It started at $400,000. So the policy is so much more efficient. Every year, the death benefit is going to increase, which is going to pull more cash value growth, more dividends. Access to more capital, growing every day, $179,267, while eliminating $120,000 of debt. So they eliminated $120K in debt while creating $179,000 in access to capital, all at the same time. Obviously, the net worth has also increased. Now, have the banking function on the things you finance work for you versus against you. And the best way to do that is by working in an environment which helps you recapture interest, not in an environment where you're losing interest or paying interest. As time goes by, economy is going to go up, economy is going to go down, and you have experienced this already. Stock market is going to go up, stock market is going to go down. You have also experienced that. Real estate goes up, real estate goes down. You have also experienced that. Interest rates go up, interest rates go down. You have experienced that also. One thing continues no matter what. That thing is called the function called banking. Someone has to control that banking function in your life, and it should be you, because it puts you in the strongest control position. And the best way to do it is by becoming your own banker, because this is how you work in an interest recapture environment. Create your stress-free way of living by taking back control from the banks, manipulative stock market, the government. Now, this is actually old. So on the left-hand side, you can see 5-star Google reviews for Ascendant Support Center. On the right-hand side, we just use Toronto location. We have several locations across the country. Amongst all these locations, we have more than 1,200 5-star Google reviews. We get these reviews because of the work that we do. We don't get these reviews for selling a life insurance policy. Our relationship with the clients are a lifelong relationship. It's not about, hey, here's a policy, hope you get there, call me in 10 years. No, this is new to you. You need coaching, you need guidance, you need support, and that's what we're going to be here for. We do group client coaching sessions. So quarterly, we invite everybody together. We pick a topic, the feedback obviously coming back from clients. Hey, can you speak on this? Can you teach on this? And then we teach that on a quarterly basis. We also do one-on-one strategy calls. That's what brings us energy, is the progress that you're going to make in the process of becoming a banker. So you should schedule your call. If you're in the US, text to that number. If you're in Canada, text to the other number. You should schedule your call, because this is how you're going to know how this can work for you, how you can build your own stress-free way of life by becoming your own banker. See how this works for you so that you can make an intelligent decision. Yes, this makes sense. I want to do this. Or this doesn't make any sense, and I don't want to do this, but I know it's going to make sense. I also want to share this with you, just some reviews. And this is some of the clients that have eliminated debt. So you can see right here, we had a tiny bit of money with one of the big name investment management groups for years. We worked hard, earned a decent income, and managed to stock away a tiny bit every month. Despite this, and let me know if you feel like this, despite this, it always felt like a struggle. We decided to go all in and give this a try. For us, the benefits were immediate. We paid off a lot of debt way faster than we thought was possible. We found we had access to cash that we didn't have before. These are just some couple of immediate benefits. The long-term benefits are even exciting. This is another testimonial. I have been participating in practicing the process of becoming a banker for over 4 years now. I'm fortunate to say that Jason Lowe is my advisor. Before getting started, I recall bombarding him with questions, speaking with his existing clients, reading books, watching YouTube videos. I consume content. Today, I can proudly say that I paid off all my debts while enjoying the process of becoming a banker. I can't express in words how empowering this process is. Removing yourself from the traditional banking system supports you in a way that you haven't seen yet. And here's another one. I'll let you read it. My family and I've been working with Cerebral for several years. We are clawing away a pretty big debt load. Here's another one. This is just one of the 12,000 reviews that we have. Another one. Another one. I have 4 policies. I've used policy loans to pay off debt, finance family vacation, charitable, things like the examples that I shared today already. He's already doing it. Again, schedule a call so that you can have clarity on how this works for you. That's the reason why you want to schedule this call. And like Jason mentioned, don't bring any money. First thing we want to establish is if you have a basis to even work together. And if you can add value to what you want to get accomplished, we'll let you know. And if you cannot, we'll also let you know.
I love that. I booked a meeting with you. I want to grow my program. This was terrific. Today was great. And for those who are still with us, we really want to just reinforce that you made the right decision to be here with us today, and can't wait to hear about all these personalized conversations that are going on with advisor teammates in Canada and the United States, and can't wait to hear and read all of the Google reviews that come from all of you and your experience and journey with the process. Today was fun.
Yeah, it was great, Jason. Roman, any questions that came up that perhaps we can answer?
Yes, but there were 2 questions, and they're very similar regarding the segregated account. So why wouldn't they put extra funds from the segregated account into the policy? Wouldn't it start working from the inside of the policy?
Yeah, 100%. Like I mentioned, that is the best way to do it. I just wanted to isolate all that stuff so that I can just give you a simple example. But imagine if that extra money was going as more financial energy as premium, what would it help create for them going forward? So the more you put into it, the more it's going to expand, the more you're going to have available, the quicker you can get to the objective. But just for making things simple, there's just too many moving parts in this example. I just kept it simple.
Also, the policyholder is in the driver's seat. That's the key.
And your money must reside somewhere.
Yeah.
And Nelson often said that if you run out of room, then you should just open up another branch of your family bank.
Yeah.
Isn't that what banks do?
Well, money must grow in branches because they keep opening more branches.
That's very true. All right. Good. Any other burning insights or questions, Roman, that you're seeing come up?
No, I mean, all the questions have been answered by the amazing teammates. Pretty much we've done good job as well. So yeah, good job, Sabo. This was terrific, especially the data capture plan. I think this will resonate with a lot of our listeners today.
Absolutely. It's a pleasure being with you, everybody. And remember, questions are good. They get you to clarity. And to get them answered, you've got to schedule a time to talk to your advisor and have that personalized conversation. That's the best thing to do. And we love, I think any of our advisor teammates would agree wholeheartedly, like we love clarifying questions because we just love to teach the concept. All right. I'm gonna hop off and wish everybody an outstanding rest of their weekend.
Yeah, me too. Thank you guys. Thank you so much.
Very much.